Hi everyone. We will start in a minute as we are still awaiting the participants to join. Good afternoon, everyone, and welcome to the afternoon session of the JC3 Finance for Change flagship conference hosted by Bank Negara Malaysia and Securities Commission Malaysia. This event is supported by the UK government's ASEAN Low Carbon Energy Programme in partnership with EY. This conference would not be possible without the support and hard work from CIMB, SME Bank, and Zurich, and without the help from our knowledge partners Climate Governance Malaysia, WWF, FIDE Forum, Swiss RE, Fair Finance Asia, AFI, and IFFIM. I am Sonal Agarwal from EY, and I'm an Associate Director in the Strategy and Transactions Practice of EY Singapore. I focus on renewable energy and green finance in the region, and today I will be your MC for this session. Some of you may not have joined the morning session, so please allow me to share a bit about JC3. The JC3, the Joint Committee on Climate Change, was formed in 2019 and co-chaired by Bank Negara and Securities Commission Malaysia, with members comprising senior officials from Bursa Malaysia and 19 industry players. The JC3 is set up to pursue collaborative action for building climate resilience within the Malaysian financial sector. Before kickoff, let me make some housekeeping announcements. Please note that this conference will be recorded and with replays will be made available on IFFIM website. Microphones for audience are disabled, so please submit your questions and comments via the chat function. Attendees are able to change the layout and resize the panel on screen for desired viewing. We will be conducting polls throughout the session, so please stay engaged and participate as much as possible. If you face any technical difficulties, please drop a message in the WebEx chat to the host. For the smoothest conference experience, we would highly recommend tuning in with a desktop or a laptop and ensuring that there are minimal applications running in the background. I would also like to invite you to keep the engagement going on by tagging us on social media using the hashtag Finance for Change. This morning, you may have heard the messages from naturalist Sir David Attenborough, Governor of Bank Negara Malaysia, Dato' Noor Shamsia, and the UK Regional COP26 Ambassador for Asia Pacific, Mr. Kenno Flaherty. We had panel sessions covering why and how to begin your sustainability journey. This afternoon, we have split ourselves into selected sessions to get you into deeper discussions about specific segments of the finance industry. You are in the segment focused on topics relevant to asset management. We have industry experts from Aberdeen Asset Management, Wellington Management, 2 Degrees Investing Initiative, BNP Paribas, WWF, and EY to share knowledge on sustainability in the asset management business. I request you to keep sharing what you learn on social media with the hashtag Finance for Change, and please post your Q&A and comments through the chat function to stay engaged. Without much ado, I will move on to the agenda. Our first session for the afternoon will be a presentation entitled Examining the Past and Visualizing the Future. This will be delivered by my colleagues from EY, Russell Marsh, who is the Green Finance Lead for the UK government's ASEAN Low Carbon Energy Programme from EY Singapore, and from EY Malaysia, Arina Koch, who is a partner in Climate Change and Sustainability Services team. We also have Suzanne Biegel, founder, Catalyst at Large, and an expert in gender smart investing, joining us at the end to provide an insight on how gender relates to climate. This presentation sets context for this focus session by talking about general sustainability risks, impact to the financial services sector, adapting business model to the sustainability, and different opportunities. This will also set 2030 sustainability commitments, talk about sustainability commitments, amongst other few things. Since this is a common session to be delivered in all the five tracks being delivered right now, we had to pre-record it to provide everyone with the same content and experience. Over to you, Russell, Arina, and Suzanne.
Hi, good afternoon, everybody, and welcome to this afternoon's session called Examining the Past, Visualizing the Future. My name is Russell Marsh.
Apologies, everyone. I'm getting a couple of messages saying that there is no audio for some of you.
Hi.
We're just fixing it. Give us a minute.
Welcome to this afternoon's session called Examining the Past, Visualizing the Future. My name is Russell Marsh, and alongside my colleagues Arina and Suzanne, I will be presenting for you this afternoon. So firstly, the three speakers you hear from this afternoon are myself, Russell Marsh, and I'm a director at EY based in Singapore. My colleague Arina Koch, who's a director at Ernst & Young in Malaysia, and Suzanne Biegel, who's a founder from Catalyst at Large and a co-founder of Gender Smart Investing. So today we'll be covering an overview of the general sustainability risks and what that means in terms of impact on the financial services sector, how business models need to adapt to reflect that sustainability, and particularly looking at opportunities for sustainable finance, aligning sustainable finance to national 2030 commitments, looking at how you integrate governance and management in terms of looking at sustainability, looking at enablers for sustainability change agents, and then finally, gender and climate investment. So firstly, and I'm going to lead this part of the session this afternoon, just looking at what are sustainability risks and how do they impact on the financial services sector. So firstly, what we're seeing is a range of activities that are creating pressure on businesses to increase their focus on sustainability and ESG. And I think it's pretty clear now that sustainability and ESG is no longer an option, but it's a necessity if businesses want to stay relevant. On this slide, we just outlined a number of those pressures that are changing and coming to businesses, and particularly the financial sector, why they need to start really taking into account ESG and sustainability. And that's both in terms of the first one on that slide, in terms of the science, in terms of changing with the warming world, so in particularly in relation to climate change. That's leading to increasing prominence and focus on the global agreements for climate change and getting countries to take on increasingly tighter targets for emission reduction. You've then got national governments increasing their regulations around how financial institutions and corporates more broadly should take into account a focus on climate change in particular, but broader ESG. You've now got an increasing demand for non-financial information from investors, all looking to understand the ESG impacts of their investments and asking those companies that they invest in to provide much more non-financial information and much more ESG investment and data as part of their decision-making processes. And we're seeing consumer behavior changing. So consumers are starting to demand more products that provide a more positive impact on the environment and more sustainable products. And so we're demanding that through their purchasing, that they're starting to look at these, adapting to and buying these kind of products. So looking particularly right now, we're obviously in the middle of and hopefully coming out of the COVID-19 pandemic, but the onset of the pandemic and this increased focus on climate change has really highlighted the importance of ESG in investment decisions. And looking at the stats on this slide, what it's showing is how investors are viewing a number of these ESG issues. And it's clear that majority of investors are really starting now to look at a whole range of ESG issues, whether that's climate risk and natural resources, whether it's gender diversity, whether it's evaluating companies' non-financial performance. So there's a range of different factors that investors are now looking at when they start looking at their operations. And you can see that that has grown over the last couple of years in terms of that slide on the left, or the left of that slide, showing the percentage of respondents in the survey, how they looked at things like environmental, social and governance risk, and that's dramatically increased from 2018 until 2020. And taking that a little bit further, we've now seen that the top identified global risks have shifted very much now towards focused on environmental, social, and ahead of economic factors. And this is a study that was done by the World Economic Forum. It's looking at this global risk report. So if you look at the difference between the top 5 risks on the left and the top 5 risks on the right, it just shows how now extreme weather, climate change, natural disasters are much higher risk than some of the economic risks that were at the top of the list in 2010. So that's just a clear indication of how global risks are being looked at and how climate change in particular is now seen as a significant risk. And looking at that again in a different way, this is another similar graph from that report from the World Economic Forum in terms of global risks. And showing that climate action failure is identified as the risk that have the greatest impact and is the second most likely long-term risk that's been identified. And what we've seen, in terms of the global pandemic, we've seen what happens if you ignore the long-term risks of things such as pandemics. And obviously the goal now with the pandemic is to reduce harm while waiting for a vaccine. However, there is no vaccine for climate change, so we need to take action on climate change very differently to how we're dealing with the pandemic. And the other thing to recognise, obviously, is economic activity has bounced back after the financial crisis, and that's starting to see emissions increasing. And so we're going to look at how we can grow the economies, but as we emerge from the pandemic, but without having that similar impact on global climate change emissions. Also seeing climate change impacts are now emerging much more quickly than anticipated. And on the left, just highlights a number of the measures and impacts of climate change. And it's showing that we're starting to see all of those increasing much faster than had previously been seen, whether that's ocean heating, sea levels rising, or the Greenland ice cap melting. And that's leading to things like greater income inequality, higher food insecurity, and increased urbanisation as people have to move away from areas that are going to be subject to coastal flooding in particular. So then looking at, what does that mean? So how does climate change, how do those natural impacts of climate change end up becoming a source of economic and financial risk? And what this slide does is look to just summarise that at a reasonably high level. And what we talk about is 2 things. We talk about physical risk and we talk about transition risk. So the physical risk is the risk by an actual natural disaster event, so like an extreme weather event, what that actually the impact that can have on the financial sector, again in terms of having to build back that infrastructure that's destroyed. That's a definite risk and a physical risk on the financial sector. And then you've got transition risk, and this is the risk to corporates about having stranded assets or this move towards a lower carbon economy. So an increase in policy and regulation from governments, emerging technologies that take over because they're low carbon, taken up by the market, and general market sentiment. Again, we talked earlier about how you're starting to see a number of drivers on companies to move towards incorporating ESG considerations within their operations. And if companies don't respond to that, so they can end up, say, having a big financial impact as the products they provide are no longer wanted by the market, or to say the products they produce are impacted by changes in policy and regulation. If you're thinking particularly about the energy sector, obviously as governments increase their focus on reducing carbon emissions from the energy sector. If you've got a high carbon intensive energy sector, that can be a big risk in terms of the speed at which some countries are taking that transition to a lower carbon energy sector. And looking at that a slightly different way, this takes us a little bit further. Says, okay, how do we see those climate change effects come through in terms of the economy and financial stability? And looks at, say, both again from the physical risk drivers and the transition risk drivers. Where you see, as a result of physical risk, you see this business disruption. You might see capital scrapping, and that will lead to potentially lower property values, lower household wealth, and that can have a link through into the financial system in terms of financial market losses, credit market losses, etc. And then similarly on the transition risk, where you're seeing changes in climate policy, change in technology, change in consumer preferences, you could potentially have stranded assets in terms of fossil fuel generation technologies, some real estate infrastructure, etc. And that can lead to corporate asset devaluation, lower corporate profitability, etc., and then have lead to financial market losses. Then there's obviously feedback loops within that in terms of the financial contagion through market losses and credit tightening, feeding back to the economy. So what you're seeing there is at a relatively high level how, in particular, climate change can have a direct impact on the financial system and a direct impact on the economy, and therefore, how businesses broadly and the financial sector particularly start thinking about how can it adapt its business models to respond to that challenge, and in particular also thinking about the opportunities. So what this does is look at, again, how does sustainable finance, what does sustainable finance mean for the full business model of an institution? And what this slide looks to do is try and look at, across the whole of the operations of a business, what's their role and what's the impact of this continued focus on ESG and sustainability and sustainable finance on that company. And that's everything from so you've got the business implications and challenges on the left. You've got, in terms of shareholders, you've got change shareholder goals. You're starting to see increasing shareholder activism, where you've got shareholders who are looking to really change the internal process of the company and get it to take on higher targets, particularly for climate change emissions, through using its ability as a shareholder. You're starting to see new investment products coming out into the market. You've got new terminology, new regulatory requirements you need to understand, and how you can embed those within your risk management system. You're going to have new and changed risks. So the risks that you're facing now and the risks you might face under some of the scenarios for climate change could be quite different. So you need to understand how those risks are changed and how that fits within the company. You may start to see changed policyholder behaviour, changed employee behaviour. Again, employees looking to see their company do more in some of these areas. So how do you respond to how employees are starting to view these issues? Your business partner behaviour. Again, working with a lot of businesses. What are they doing? How are they changing their behaviour? How are they responding to these demands? So I think also looking at product innovation is not all risk. It's also looking at these new market opportunities. Particularly look around in terms of the energy transition, moving towards a lower carbon economy. The amount of investment, the amount of new technology we're going to need to meet some of those targets is huge, and that's where there's real opportunity for companies to start looking at where they are now and where the opportunities are in the future, and how they can start to move towards embracing and taking the benefit of those new opportunities. And this looks at this a slightly different way in terms of looking across different parts of how this transition, these strategies for sustainability works across different parts of the organisation. So you've got products. So we know, again, we talked about consumers continuing to demand more ethical and sustainable practices and products, and again being able to have products that meet that need. Within internal operations, again, how can you make sure that your internal operations are becoming more inclusive and environmentally friendly, and having those internal policies that help drive those activities? So, impact investing, where FIs are now looking to invest in projects, companies, or organisations that have some positive social and/or environmental impact. So, looking explicitly to seek out those opportunities to only invest in technologies and companies that have provide this specific environmental impact, whether that's renewable energy, social housing, as some examples. Looking at distribution again, how can you adopt sustainable ways of distributing services? So there's this US bank with its in-app voice assistant, so it provides better accessibility for banking services. And again, just to see how the distribution of these services is changing to meet the needs of retail customers in particular. Collaboration, collaboration seeing, particularly in the sustainability space, we're starting to see a number of external partnerships between financial institutions to help increase and offer this wide range of integrated ESG solutions. The example put up here is about BNP Paribas collaborating with Greenly to offer some carbon tracking to its consumers through their banking app. And that's just an example of how collaborating externally can help drive a new product and innovation that this particular institution wanted to deliver. And then policy, again, how you're integrating and incorporating ESG into operations. And a number of banks and financial institutions and others are signing up to various frameworks and strategies to help align their operations alongside related ESG-related causes. I think it's fair to say now that financial institutions need to do more to overcome the barriers and reap the benefits that ESG provides. And this slide looks to look at some of those. So this integration of ESG into risk management services, so really having ESG criteria integrated as part of their already risk management frameworks to help move their capital flows towards more sustainable investments. Looking at addressing gender diversity just beyond equitable workplace ethics. So looking at how you extend some of these frameworks around gender diversity down the supply chain and to customers as well. Common taxonomy, this is often the most difficult one in terms of, again, how do you define what we talk about when we mean sustainable? And sustainable practices and sustainability means many things to many different people. So have an agreement around what is a common taxonomy? What do we mean when we talk about sustainability is really helpful. And also useful to see that there's work going on within Malaysia to help try and develop some sense of what that definition looks like within the Malaysian market. Again, common standards for ESG disclosures. There's a range of different standards out there. And again, having this convergence and global guidance on sustainability standards will make it easier both for the industry to adopt those standards, but also then for the external stakeholders to be able to follow and understand what it is that companies are doing. And then elimination of greenwashing, and this comes up quite a lot in terms of being really clear that what you're doing and what you're promising you are doing, and the consumers and others can have real confidence in that again the ESG claims you're making are actually backed up on what you're doing. And this is just one example, and I won't bear on this too much, as again you can look at the slides in your own time. This is just an example of where Barclays, a bank, is focusing on products, distribution, impact investment and policy for its sustainable growth. So how it's looking across all of those issues, both, and a couple of examples we put on the slide in terms of looking at green home mortgages, looking at sustainable investing solutions. It's looked at financial inclusion for the disabled. It's looked at how it works with some financially vulnerable consumers, and it's had an impact eligibility framework, providing clear social, environmental and inclusion criteria to track and categorize financing volume, so including labeling green and social transactions. Again, that's just an example of how this particular financial institution is looking across all of those different criteria to look at how it can become a more sustainable company and has more sustainable growth. So I'm now going to hand over to my colleague Arina to take us through the next few sections of this afternoon's presentation. So thank you very much for the moment.
Thank you, Russell. And I'm going to kickstart with the next part. What we're going to do for this next session is really to discuss about how, essentially the finance for change can actually drive or rally, direction from all sources, as well as how does it align not just from a national 2030 commitments, how do organizations like financial institutions can drive this, and down to the granular detail of what each enablers or business unit can do. Now, looking at the next slide. Sorry. Looking at the next slide, when we look at what Malaysia has been focusing on, we do have a commitment to achieve the 2030 Agenda for Sustainable Development that addresses the key mega trends. So in 2021, the United Nations Sustainable Development Cooperation Framework 2021 to 2025, the UN SDGS, constitutes how the UN development system could support Malaysia's strong commitment to achieve the agenda. And it's really very much focused on the aspiration for Malaysia to become a high-income, inclusive, environmentally sustainable, and advanced democratic nation. And what this framework helps is to support, effectively collective system support for the country to address where are the bottlenecks, the trade-offs, the synergies towards the journey, and essentially to also provide the United Nations system support to strengthen the whole of nation approach to achieving these SDGs. And when we look at the diagram here, these are the 6 focus areas, as you can see, and how it's aligned to the 17 SDGs. Now, I just want to highlight that these are the key material issues where we have to actually have a targeted fit for purpose solutions that actually can drive multiple benefits on these areas. So when we look at the population growth and demographic change, there will be certain strategic areas that can also be addressed by the likes of digitalization, how this can actually drive certain microfinance, whether the digital banking can actually drive some solutions towards the new world order, and what are the pressure on the ecosystem in terms of the health requirements, as well as the food security discussions. What are the societal changes and changing face of the customer? When we look at infrastructures are being reconstructed and re-looked at to consider the drive of EV infrastructure, or the likes of upgrading in terms of not just on renewable energy but consideration of storage and CCUS. These are the mega projects of technological innovation that will come into play. Of course, the key question now is how does finance as well as the larger ecosystem bring this change? So looking at where the funding gaps are essentially focused on, when we look at the statistics that has been put out in place, so according to the UN conference on the trade and development world investment report, between $3.3 to 4.5 trillion needs to be mobilized annually to achieve the 2030 Agenda for Sustainable Development. Now, this essentially highlights the funding gap for investment, and this is where the opportunities lies in for not just the public, but also the private sector, especially for developing countries, which is estimated at $2.5 trillion. Now, the graph essentially outlines the 2.5 million, but what we want to highlight is when we look at the graph chart on the right-hand side, you can essentially see where the key gaps are in the power sector, focusing on power sector, and the climate change mitigation, transport, telecommunications, and ecosystem or biodiversity. So this is where the focus areas and the growth drivers are going to be angled by most investors as well as companies on this journey. Now, when we look at examples of how financial products and services can essentially drive or address the sustainable development goals, for all these 16 goals, including the 17 on partnerships, the focus areas essentially, when you look at no poverty, it's essentially driving finance through impact investing. I mentioned about microfinance for smallholders farmers can actually support the goals towards zero hunger. And when we look at healthcare investments, it does essentially drive good health and well-being. And this is where there are digitalization in terms of telemedicine, having the digitalization that will actually help the outreach for those underserved. And when we look at philanthropic donations to schools, it doesn't stop there, but it could also be enabled by digital education. And when we look at microfinance and lending to women and female entrepreneurs, that's where it would drive gender equality and keeping women and the underserved to actually have continuous career to support their family income. And then when we look at clean water and sanitation, this is where socially responsible funds can invest in water and sanitation, and this can also drive access to businesses as well for the underserved. And for affordable and clean energy, I think we mentioned about renewable energy investments and new technologies. For decent work and economic growth, there are general investments to the real economy. For innovation infrastructure, it would be essentially relooking at how project finance or commercial can lend and integrate ESG criteria in their lending decisions, which we will see a huge significant ramp up in this year for the financial sector. And in terms of reducing inequalities, it's essentially to drive fair payments, not just for financial sector employees, but also to drive it, in terms of the investees or the customers that you're lending to. How do you then advocate for those policies? For sustainable cities and communities, it's also considering, how do you look at the mortgage lending to provide more climate resilience enablers, to actually discuss on how climate risks are being mitigated, and adaptation considerations. For responsible consumption and production, is essentially driving the socially responsible investing. Climate action we'll cover in more detail, including financial ecological services that covers life below water and land, and essentially, lending to public institutions to consider for, driving peace, justice, and strong institutions. So when we look at, how sustainable finance have become urgent to achieve low carbon economy, essentially is also looking at, how it is already impacting, if not every aspect of the economy. So I mentioned about, the connectivity, not just on agriculture, residential, human health, labor productivity, but what essentially would be key is what are the societal issues or environmental issues that has to be tackled. So these are the key questions to ask, as part of the organization or as part of society is, should leadership on environment or social issues be an essential part of the purpose of the organization? What are your current engagement on environmental and social issues, whether it's authentic to your culture, brand, and your products? How do you play an active supporting role in transitioning to net zero? Every organization has its roles and responsibility, but how do you integrate this within the organization in the day-to-day operation? I mean, in terms of what does each commitment looks like. So we thought, it would be timely to actually just highlight here that there are various iterations of what a decarbonization commitment looks like. Here we see carbon neutral, carbon negative, net zero, and science-based targets. Having that different equation or iteration, whether does it cover emissions, is it being offset by removals, or it can be offset with science-based targets. So these are the 4 different iterations, and organizations need to then define which one works for them in order for them to consider what commitments are most reflective of their vision, mission, and their direction in the short, medium, and long-term future. So when we move on to the next part, after looking at the macro scenario, now let's get on to the institutionalizing, how do we then bring this into the organization, going to the granular detail. So when we look at the integrated governance and management approach towards sustainability, I would like to just keep the key focus in the next slide. Okay, so when we look at the governing body or audit committee and consideration internally and externally, when we look at the organization, typically for financial institutions, there is the essential 3 lines of defense. You have the management controls and internal control measures as the first line of defense, where they carry out the sustainability risk assessment when onboarding clients during pandemic review or existing clients. Now, the idea is also then apply that for environmental areas and to also engage with clients to understand their level and business plans and to consider the uncertainties. When you look at the second line of defense, essentially it's also the second part of the organization that looks at the financial controller, security, risk management, quality, inspection, compliance. How did the second line of defense actually set up their own central risk frameworks, deliver the training, develop scenarios, and undertake stress testings. And these are the part where it goes to the third line of defense, where you have the internal audit as well to review the control, design, and execution. What's to highlight here is this does not stop there. There is also the external audit consideration and the regulators who will also evaluate from the external viewpoint of things. Now, when we look at how this will actually change the approach, essentially learning from what the pandemic has impacted in terms of the governance, it has it reinforced the importance of the long-term value approach to actually build resilience. And in terms of the drivers of the approach are pretty much the key stakeholders and the business leaders, where there are increased expectations, where organizations need to play a more proactive role in tackling the societal issues, including climate change and inequality. And you also see business leaders who now start to, have that conversation, how the CEOs and board are connecting and driving the sustainability performance strategy and targets. What's their role in driving, having lead a more purpose focus, to address the various key stakeholders' needs. So this essentially, outlines a research that was done by EY that actually highlights, to what extent the board has put in place the following practices. We can see that there is a growing, based on, long-term value maturity, there is a growing need to actually evaluate, what the strategies are in terms of improving the long-term value. And where we see the laggards are is essentially also considering, how do you then incentivize, the remuneration schemes to ensure that this long-term value are being driven internally and they're being compensated as well, aligned to actually ensure the longevity of the organization. So when we look at the framework, how to integrate the approach to address sustainability, typically it cuts across two aspects. One is on the strategy, one is on the compliance. When we look at the strategy governance, it is also to look at how do you drive that proactive, taking certain risks, looking into ventures, where the sustainable finance, where the risk and strategy and opportunities lies in, what are the transformative that the organization need to look for. When we look at the compliance side of things, essentially you have the board risk committee that actually looks at where the risks are, as well in terms of the stress testing, the financial capability, and where the portfolio would look like. So these are the two hats that typically would be be institutionalized within an organization. There is a part where the more proactive pursuit and risk-taking side of the business, and there is the other part that is a more risk management kind of approach. But essentially, this falls within the organization, essentially, and how this is being driven is to really have that two enablers within an organization rather than just have one set up. So the eventual integration to the business functions as well as rules needs to be clearly outlined to actually drive an effective integration. So when we look at breaking down even further what the enablers or sustainability change agents are, this is where we look into the setup organizational function, where we look at where every facet of the organizational and operational structure is affected by the ESG. And we can see that from the high level to the board and supervisory board level, you would then need to consider now in terms of the how the board drives sustainability strategy, performance, and targets. You will also consider how the board risk committee will actually evaluate risk. But you will also consider now for remuneration committee, how do they connect the performance of the board and senior management as well. So this is where the high level set infrastructure would be before it's trickled down to the next core process as well as the supporting process. The core process, essentially, when we look at product management, it would be looking at the various sustainable investment. How do you consider the green and brown assets and greenwashing? Where you talk about marketing, there's also market position. Where do you communicate your performance? How do you manage the engagement with your internal and external stakeholders and the regulators as well? And in terms of the sales, is essentially to drive, what are the financial advice that you're going to give to your investees, what are, as well as to your customers, coming up with various products that actually fit their needs, and considering whether is there opportunities to drive new technologies as well in terms of sales. And in terms of processing and handling, there is, the discussion of the conflict of interest, taxonomy, what's the use of funds, and when you come to customer service, it's essentially how do you handle the grievance mechanisms, the complaints and the governance structure. So when we look at the support processes, these are essentially where the other parts of the functions of the organizations is the legs, the arms, the heart that actually need to also rally together. This is where you see in terms of the laws, the regulatory affairs, the finance, the compensation incentives needs to now come together to actually see how they can actually consider the advancement or the components of ESG into how they actually operate, incentivize, provide legal advisors, handle the business operations, whether, when you look at asset management, how effective are the assets and how resilient is it, towards flood, climate risk. So these are things that needs to be considered. I will move into more detail when we talk about these aspects. When you look at integrating sustainability into procurement, what we see now is essentially the drive on improving global human rights situation, and as well as fostering the UN SDGs. So it's also considering, what are the greater responsibility to contribute to climate protection, material efficiency, what are the social standards and good governance that needs to be driven in the supply chain management, as well as, when it comes to risk mitigation, how do you ensure the security of your supply chain? How do you maintain the license to operate through management of ethics and regulatory framework? But when it comes to, what sustainable procurement really means is essentially to have clearer transparency, have a clear monitoring material sustainability risk in the value chain. And what we have seen is most organizations are starting to come out to see how they set the standards for their sub-suppliers. They would evaluate and say that, how many has been, not meeting the standards. Hence, therefore, they are being coached or they are being advised on how to enhance, the supply chain standards as well. And when we look at where the opportunities lies, essentially is to drive profit in terms of efficiency, accelerating the sustainable business solutions, to actually handle significant perception. How do you position in the market for transparency in your supply chain management, and to essentially also grow and drive the performance, attracting new talents, ensure customer satisfaction, that you are essentially the brand to come in together and be aligned with. Looking at, in terms of building facilities and management, the consideration is the need to actually plan and mitigate physical risk on your buildings and facilities. We had the flood in January, a massive flood, and a lot of operations and branches of financial institutions are impacted by flood. The question then is, how has those been factored in and considered? And when talk about, energy, carbon, and environmental taxes, how do you consider that as well, impacting your transition risk? And in terms of smart building and energy efficiency, we're seeing quite a number of retrofit being done on buildings, and the shift to renewable energy, putting solar rooftop panels, and as well as driving a lot of energy efficiency with automation in the smart building elements of the operations. So in terms of, occupational health and safety with the COVID, there's also a need to have the awareness, well-being, and there is a discussion on as well on driving mental health and well-being concerns, especially in the lockdown situation. So what building and facilities management needs to have in terms of consciousness is really to invest in green technology and assets, consider what are the ways to actually coordinate the carbon footprint and energy audits of the assets, and what are the environmental health and safety considerations in the supply chain when people visit your facilities and building management. Where the opportunities are essentially with all these automation, it can actually optimize energy, carbon, and environmental taxes. And essentially is also to drive and reduce exposure to environmental disaster. You can actually help to actually drive renewable energy where it can be managed in a larger scale, and it as well as handle the facilities for effective employee management. So when we look at integrating sustainability into human resources, what we see in terms of the drivers and trends are the digital and technological advancement in having better digital tools to enable the mix of on-site and remote working, which is quite critical in this space of in the current situation of lockdown. But with that rise up in terms of digitalization, there's also concern on cybersecurity and data privacy. There are also discussions about the issues surrounding digital inequality and social fragmentation, driven by educational disparities, unemployment, and gender and inclusion issues. So this is where it's essentially the human resources can also consider what the new climate economy would look like in terms of generating more jobs or new jobs, or how employees could then pivot to the new requirements of the low carbon and energy kind of low carbon economy kind of green jobs and green skill sets. So this transition is also to consider whether it can actually boost female participation to ensure a more inclusive employment landscape, and what are the new skill sets that comes with it. In terms of what sustainable human resource management would look like, is essentially to look at how they can reevaluate how the mobility strategies are being put in place, incorporate the risks and opportunities capability building cut across the organization, promote gender inclusion and equality in workplace, encouraging volunteering and green champions within the organization, drive sustainability training as part of a fundamental onboarding training, provide adequate training educational opportunities to boost adaptive capacity and reduce the vulnerability of them losing jobs in where we pivot, and linking, more importantly, is linking remuneration and promotional opportunities that comes with sustainability practices. So when we look at opportunities, it's essentially capitalizing the gains from remote working to actually boost morale, motivation, and contribute to sustainable business by having more efficiency, creating green new jobs, and that allowing employees to pivot. It will definitely increase the market branding or perception of the organization when you clearly drive these values and have clear ways to actually drive transparency in how you actually mobilize sustainability considerations in the organization. It will also help you to attract talents, have a diverse talent pool, and also reduce the needs of paper consumption, mobility, travel needs in that respect. So when we look at the next part in terms of the legal and compliance, what we see is, as I mentioned, a global direction to improve human rights situation. In terms of regulatory, there is increased regulation and standard setting that actually considers ESG management at the governance infrastructure, how these standards are being implemented, as well as how the communication are being done in an effective manner. How do organizations take responsibility on ESG management risks and opportunities? And it's always essentially as well to handle the greenwashing risk. And now we also hear the social washing risk as well coming up, and to also consider what are the risks of damage and litigation due to the externalities, climate change, and natural disasters. So what the sustainable legal and compliance would then look like is really to have that capability and competency to scan and understand what are the risks that affects the companies, to also drive how they can operationalize and manage the stakeholder expectation. We've seen more enhancement on having a stakeholder management strategy and policies being put in place, as well as having the knowledge of the entire legal team to be aligned to sustainability issues management, and to also regularize the internal engagement on sustainability issues. And moving on to opportunities, what we are seeing is it would help to mitigate the cost of non-compliance with any ESG laws and regulations, to also grow and improve the inclusiveness of the policies, to drive connectivity in having a diverse talent pool intersecting with human resources, and to manage the transparency of disclosures and strong compliance with laws and regulations. Now, last but not least, in terms of marketing and branding, which is essentially quite critical for most organizations, is there are increasing negativity in terms of publicity as associated with poor ESG risk practices. There is also a consideration of whether there are greenwashing, or essentially not having that transparency in, for example, the products that is being put in place, or the green investments that you actually commit to. So this is essentially to also understand what the customers, regulators, investors, or all stakeholders are now looking for. What are the information that they are requesting to be put forth to public, and how the COVID-19 has accelerated the momentum to have ESG being brought up to a higher increased bar of how these financial institutions are driving the force of change. And you see that in terms of the platform infrastructure that marketing and branding are using, There's also an increased online banking apps. So this will actually, need to weave in the consideration of how you actually communicate ESG management. Now, in order to look at how a sustainable marketing and branding will actually evolve, there would be a clear direction to actually enhance ESG transparency, ensure that there are specific tangible commitments and goals that aligns and connect to the products and services that are being offered. And you can essentially, the organization communicate the results and outcomes in a timely, effective manner with clear timeframes. There will also be, a significant increase on how do the organizations educate customers on the benefits of ESG products, as well as embrace the digitalization to provide the enhanced value as well. Of course, when you look at the opportunities, it would help to actually enhance your market positioning. When you offer measurable results to support your commitments, you are also able to then look at what are the various avenues of customer satisfaction that you actually can capture. And most organizations we see in the market who are leading on marketing and branding, they start to put out in place how strong do they evaluate their relationship with key stakeholders. So this is where the strength and the surveys and evaluating the stakeholder management strategy comes about, and how do you then inform that results to the public. So with that, I will pass on to Ms. Suzanne Biegel, who's the founder of Catalyst at Large Expert, to actually take us through the Gender Smart Investment chapter. And over to you, Suzanne.
Good afternoon, all. I'm so delighted to be here to speak with you today as one of the technical partners for the ASEAN LCEP, and I want to thank EY. My name is Suzanne Biegel, and I'm the co-founder of the Gender Smart Investing Summit, a global initiative to unlock gender smart capital at scale. And today I'm going to speak with you about the nexus of climate and gender finance and the urgency and importance of bringing these two themes together. And I'm going to be pulling from our report, Gender and Climate Investment, a Strategy for Unlocking a Sustainable Future. Next. Let's get started by talking about the context for the growth of the field, the urgency of why it's so important to consider the nexus of gender and climate finance, and dive in. Next. You've already been speaking about climate change, climate finance, but most climate finance is not yet gender smart. Next. There's a huge demand, of course, for climate finance to facilitate and accelerate the transition to a low carbon economy and a resilient economy. And at the same time, we need to be conscious of how climate impacts different communities disproportionately. The poor are especially vulnerable to the effects of climate change, and the majority of the 1.5 billion people living on the planet under $1 a day are women. Gender-based differences in women's and men's vulnerability, as evidenced by mortality rates in extreme weather conditions caused by climate change, stem from gendered norms around mobility, skills, employment, and other factors which limit women's participation and access to resources and economic opportunities. But we must not only see women as victims of climate change, tackling of gender inequalities can positively influence climate action. And as a study from the IMF shows, policies that improve access to educational opportunities and finance for women can lead to a reduction in not only inequality, but an increase in economic growth for the developing country. One Brookings Institution study suggests that for every additional year of schooling a girl receives, on average, her country's resilience to climate disasters increases. Why is this? Because she can make educated decisions about sustainable choices and preparedness, resiliency. For example, an educated farmer can make different crop decisions and financing and irrigation. Next slide. Finance can deliver enhanced climate and gender impacts, but beyond this, climate and gender investing is just smart investing, period. And by bringing these lenses to bear on investment decisions, we see the potential for increased returns and decreased risk. And we've articulated 5 reasons. This is not a hierarchy. We believe these are all important, but these are some of these are more relevant for others in looking at different investment actors and actions. First, integrating climate and gender investment approaches can help to uncover new investment approaches. Women innovators and entrepreneurs are creating disruptive solutions, and addressing gender in a product or service solution can unlock products and services that are more responsive to market needs. It's also about mitigating risk. Climate risks cannot be diversified away. They affect all businesses, whether directly or via customers, suppliers, and communities. And failing to address gender can be a source of market risk, operating risk, or even reputational risk. Companies or funds may fail if they brush off the gendered needs of employees or customers or suppliers or other stakeholders. And gender smart and climate smart investing provides ways of mitigating those risks. It's about meeting investor expectations. It's about driving long-term value, because a gender and climate lens can drive competitive advantage and long-term value across talent, innovation, markets, products and services, value chains, and governance. And as climate and social impact enter mainstream thinking, regulation, and policy, those who fail to adapt at risk falling behind. And finally, of course, amplifying social impact. Looking at gender equality and climate action cuts across so many other SDGs, and all development finance, and indeed all finance with the SDGs as an objective, is beginning to recognize that gender is a cross-cutting theme. So we believe that long-term, there'll be a correlation between these companies driving positive social returns and having an increased impact on financial returns. Next slide. I want to share this quote from Mark Carney, which you can read yourselves, the UN Special Envoy on Climate Action and Finance and former governor of the Bank of England. Mark Carney is an international gender champion who is pledged to champion the use of the 2X Gender and Climate Task Force tools on climate and gender, and to champion better access to climate risk training opportunities for central banks and supervisors, particularly in emerging markets and economies. Next slide. Both fields are growing fast. I don't need to tell you about the growth of the climate finance field, but I will tell you about the gender lens investing field. We estimate that by the end of 2020, there was more than $18 billion in public and private investment vehicles moving with a gender lens. And this chart illustrates the growth of those vehicles. And these two areas of climate and gender have tended to operate in silos, but the integration of the two can unlock tremendous opportunities. So we ask ourselves, what if all of the capital flowing into climate finance today had a gender lens? To build a realistic picture of the opportunity to bring these together, critical data gaps are there, we recognize that, but we have the opportunity to be carving out new solutions and examples across ASEAN. Next slide. I'd like to take a second to highlight the ASEAN region as an example of a way to bring together gender and climate. The East Asia and Pacific region is the largest provider and recipient of climate finance globally, with 250 billion USD, comprising 44% of total flows. And gender lens investing is up 160% in ASEAN, with 22 active gender lens investing vehicles across public and private markets at a total of 1.1 billion USD. In addition, annual flows of 250 billion into climate-related projects represent a huge opportunity to significantly scale up gender lens investing in the ASEAN region, although it hasn't happened yet, through ambitious gender-related KPIs being intentionally integrated across all climate finance by default. And some of the public capital providers have made some commitments in this regard, but to date, this opportunity really remains largely untapped in the ASEAN region, but it presents a significant opportunity to be a leader, both for women and for the world, and for climate outcomes that we're really looking for. If you go to the next slide, I want to talk a little bit about some of the principles around applying these lenses. Next slide. So this is about bringing together a climate and gender lens together, not only in what we're investing in, but who has a seat at the table, and what kinds of companies, what kinds of funds, what kinds of ways this comes out in an infrastructure project, and where financial institutions have a role to play. There are a few different ways to think about this. One is to apply a gender lens to climate finance, existing climate finance, and to think about how do the company's products and services or value chains really impact the lives of women and girls? You can also apply a climate lens to gender finance. So thinking about where gender bonds, gender-specific investment vehicles are, and think where are the green opportunities within those opportunities. And then really thinking from the very beginning to bring gender and climate together. Are there gender-specific opportunities to improve climate and business performance? And what would you look at? You would again look at leadership, you would look at governance, you look at supply chains and employment, you'd look at customers and communities, and you'd be thinking about where might I be spotting an opportunity by paying attention, or spotting an opportunity by spotting a risk where I'm not paying attention. And I'll get into that a little bit more. Let's go to the next slide. The key actors in this ecosystem are, of course, all of the finance providers and capital providers, from the central banks, the DFIs, foundations and family offices, the fund managers, but the intermediaries, the coalitions and networks, the consultants and advisors that are bringing these kinds of products to market, and the movement building actors. And then finally, of course, on the company side, to really be looking at businesses across ag, across energy, across transport, across manufacturing, circular economy, sustainable cities. And I'm going to talk a little bit about how this comes to light in that ecosystem. If we go to the next slide, money's already moving, and pioneer investors are leading the way here. So the DFIs, there is a set of DFIs that have collectively committed 15 billion in capital to move with a gender lens, and significantly as well with a climate lens. In 2018, they made a commitment to move 3 billion in this direction and had already moved 7 billion by the end of 2020. So this 15 billion is a new commitment. The multilateral development banks are now part of that new commitment, but they've already been acting. EBRD, European Investment Bank, IDB Invest in Latin America, the IFC, Asian Development Bank, and African Development Bank. And then funds, there are a tremendous number of funds. We're tracking more than 25 funds around the world that are already deploying climate and gender lens. And I'll talk about a few of them. And then of course, across public markets, looking both at climate and gender in an ESG context. If we go to the next slide. So you can be thinking about this from this point of view of spotting who are those entrepreneurs and innovators that either we need to be backing through venture capital, private equity, through bank finance. That can be in corporate supply chains, it could be in public sector supply chains. It might be that it's a women-owned business or women co-founded business. It might be that it's really about women in leadership. It might be about the fact that their products and services are very focused on paying attention to women customers as well as male customers. It could be really thinking about where are women in those supply chains, again, either as owning companies or as running companies or as employees in companies. So we're thinking about all of those lenses. And if we go to the next slide, and across, as I mentioned, every area of climate finance, from energy to ag to water to transport and on. So this is not just siloed in one particular area. Let me tell you about a few case studies. Agence Française de Développement, we go to the next slide, has been working to scale up gender finance through mainstreaming gender considerations in all new sustainable bond issues. In this case, a use of proceeds bond. This would mean including requirements on gender diversity in the eligibility criteria used for the selection of projects. For sustainability-linked bonds, this would imply using an additional set of key performance indicators and sustainability performance targets in the gender bond framework, along with the environmental or KPI, the environmental or social KPIs. The integration of gender considerations in the green bond framework is a novel idea. Therefore, to date, there have not been very many examples that can serve as best practices for other green bond issuers. However, there's some promising examples. Agence Française de Développement has developed a new SDG bond framework for green, social, and sustainability bond issues in October 2020. To date, AFD has only used this framework to issue an SDG bond. Therefore, instead of a green bond, this will be used as an example of how a green bond framework can integrate gender targets. Considering that AFD has been an active green bond issuer with a total insurance side of euro 3.25 billion since 2014, we might see new green bonds using this new framework later this year. And among other eligibility criteria, the bond framework requires new projects and loans to receive a neutral or positive grade in 6 sustainable development dimensions, which include gender equality alongside climate objectives. So we're thinking about access to services, control over resources and income, access to justice, combating violence against women, participation in economic, social, and political decision-making bodies, and project governance with regard to gender. If we go to the next slide, Schneider Electric, a French company focusing on energy management and automation, can use the proceeds of their sustainability-linked bond for general corporate purposes. And at the same time, it has a strong incentive to meet the SPTs that is committed to in its bond framework. If it doesn't meet its minimum KPI score threshold by 2025, there'll be a margin step up or a premium payment as outlined in the transaction document of each issue. And the KPI minimum score threshold represents on average an 85% achievement for each KPI, which corresponds to an average score of 9 or 10. This is calculated by first giving a performance score to each KPI on a 10-point scale. The equal weighted average of the scores for the 3 KPI determinants determines whether the KPI minimum score threshold has been met. And Schneider's example to show how you can integrally link a gender KPI, a climate KPI, and a training, an employment KPI is a model that you can really look at. Next slide. There's no single path to an integrated gender and climate investment approach, but the risk of waiting for the perfect opportunity or data or project outweighs the benefits of acting now, whether testing the waters with a pilot project or scaling up what it is to be done. So I hope this has given you a little bit of a flavor for how we bring gender and climate finance together, and I wish you good conversations this afternoon.
Thank you, Suzanne, and thank you also to Arina for her presentation earlier today. And that brings us to the end of our session this afternoon. I do hope you've enjoyed it. I do hope you've had some useful information. I do hope you're looking forward to and will engage in the remainder of discussion this afternoon and over the next 2 days of the conference. With that, I'll say good afternoon and enjoy the rest of your day.
Thanks, Russell, Arina, and Suzanne. I hope all the participants found this session useful in understanding how the current climate crisis sends a wake-up call, and that environmental and social risks are real, present, and relevant to all. I do see some questions in the chat box coming in, which I'm happy to take, but a little later as we have our next speaker already in. Please welcome our next speaker, Marie Gauthier. Marie is part of the WWF Asia Sustainable Finance team. She leads the team's resilient and sustainable portfolios work, which is also called the Respond work, and engages with investors to support the creation of portfolios aligned to the Paris Agreement and the Sustainable Development Goals. In the next 30 minutes, in her presentation titled Resilient and Sustainable Portfolios, Marie will talk about what sustainable investing means and share insights from WWF's Respond assessment of asset managers with Asian investment portfolios in relation to climate and natural capital risks. She will also provide us with a high-level recommendation for asset managers to improve portfolio resilience and alignment with a low-carbon and sustainable future through science-based approach to responsible investment. I request you all to submit your questions for Marie through the chat box, and Marie would answer as many as possible at the end of her presentation. Marie, over to you. You now have control of the slides.
Thank you, Sonal. Thanks a lot, everybody, for joining this afternoon. It's great to see so many participants in this session. As Sonal mentioned, I will actually be presenting our WWF Respond tool, which actually benchmarks asset managers' ESG integration practices and share with you insights and further recommendations for asset managers who want to progress on their ESG journey. Before I do that, I thought it was useful to get to know the audience a little bit better. And we have actually 2 poll questions for you in order to make this a little bit more interactive. So I think the producer of this session is able to launch the polls for you to answer directly into the WebEx platform. So now is this correct? Do I have a good understanding of how the polls work?
Yes, so the poll
Okay,
will be
great.
launched now.
Great. So what's interesting for us to know is basically in the audience today, what main reasons you see for integrating ESG into investment activities, but also which environmental issues you currently integrate into your investment decision making. So I will just leave you a couple of seconds to answer the polls. They should be visible directly on your screen. Okay, so first answers are coming in. So it seems like most of you are actually integrating ESG in order to better manage risk, to align with your clients' expectations, as well as to do good for society and the environment. And for the next question regarding the environmental issues you currently integrate into decision making, I'll also give you a couple of seconds to answer that one. Okay, I think we can end the poll at this stage. Okay, so actually not very surprisingly, it seems like most of our audience members today are heavily focusing on integrating climate change, with 88% of respondents mentioning that they are currently integrating climate change, and it's followed by deforestation and water risk, actually. Thanks a lot for your insights. So I guess this is a great segue to talk a little bit more about our WWF responsible investment tool called Respond. Before I jump into the insights and the recommendations for asset managers, I will just share a little bit of context around the tool. So the Respond tool is a benchmarking tool for asset managers' approach to ESG. It's a public-facing online website that anybody can access. You'll find more information on the website on the methodology we use to benchmark the asset managers, the responsible investment framework that's behind our analysis, as well as context information around ESG risks and opportunities, as well as the regulatory context for responsible investment. And on the analysis page of this tool, you'll actually find the benchmark, so the assessment and the analysis of all the asset managers which are included in the tool. At the moment, we have 30 asset managers which we analyze on an annual basis. So as mentioned, Respond is a tool that's based on a WWF responsible investment framework. And this framework was first developed in 2018. It's a framework that we update every year, and that is aligned with the PRI principles as well as the TCFD recommendations. So in addition to doing this analysis work of asset managers' practices, on an annual basis, we publish a short insights report to better describe the trends, the regional disparities, and further areas of improvement asset managers can develop on. And the Respond tool is really was designed for 3 key stakeholder groups. So the first stakeholder group the tool addresses is quite obvious. It's the asset managers themselves, since the tool really provides them with a good overview of what they're currently doing in terms of responsible investment and how they can actually further progress on gaps. It also allows them to check how they're doing compared to their peers. For asset owners, the tool is actually very useful to gain insights on what asset managers are doing in terms of ESG incorporation and ESG practices, and further engage with them when they're thinking of attributing mandates or general engagement with their asset managers. And the third stakeholder group we look at with this tool are regulators, and we aim to provide through the tool same thing, a good overview of what asset managers are doing in terms of ESG integration in their markets in order for them to further push on regulatory developments on responsible investment. So I won't have time today to go into the details of the responsible investment framework we have developed as the basis of this benchmarking work in Respond. Just in a nutshell, it's a quite comprehensive framework based on 6 pillars, 14 indicators, and close to 90 sub-indicators. And here we look at overall responsible investment practices, but also issue-specific practices, such as climate change that you all here today on the call mentioned you were very focused on, as well as deforestation, biodiversity loss, ocean sustainability, as well as other social factors such as gender diversity that was mentioned in the presentation just before, as well as human rights and labor rights. In terms of who we integrate in Respond, so currently we have 30 asset managers included in the tool, both European and Asian asset managers. And every year we try to increase our scope of analysis. And for the next launch in January 2022, we're going to be further increasing our focus on Asia and adding 10 more Asian asset managers into the tool. So I guess the most interesting part of this presentation today is to share with you the insights from our analysis of these asset managers and share with you areas of improvement and recommendations that you can also take away within your own organizations. So not very surprisingly, what we've observed is that European asset managers are leading on responsible investment. They are the group that integrates and fulfills the most of our responsible investment criteria included in the framework. In Asia, the Japanese asset managers are really taking the lead in terms of responsible investment implementation. However, for all these groups of asset managers, there are still areas of progress and areas of further development. And the first one I would like to highlight today is active ownership, especially for Asian asset managers. So just to focus firstly on these Asian asset managers, what we've noted, for example, is that none of the Chinese asset managers included in Respond disclose publicly on engaging bilaterally with their investee companies on ESG. And when it comes to collective engagement, only half of the Asian asset managers, once again, publicly disclose on collective engagement initiatives, and all of these asset managers are Japanese. Voting, which is also a very important pillar of active ownership, is something that Asian asset managers do less of than the Europeans. So there's less support to ESG resolutions, and there's also less transparency around voting records and full disclosure on the resolutions they support towards the investee companies, but also to wider society. An area of progress that is really across all stakeholders that I would like to highlight today is twofold. Firstly, setting time-bound objectives for engagement. We really believe this is a crucial point in order to drive change and to drive influence with your investee companies. So what I mean by setting a time-bound objective is, so for example, if you're investing in the palm oil sector and you're holding palm oil growers, if you have an expectations for them to comply with RSPO certification, this commitment needs to be time-bound. There needs to be a time frame to track the progress of the investee companies towards this certification. And once this time frame is complete, this leads me to the second point of the slide, which is being transparent on progress on engagement. So in addition to giving some case studies, maybe in responsible investment reports, really having an aggregated view of the number of engagements that are carried out, the methods of engagement, but also this progress. So are these engagements cycles completed? Have they been successful? Is still more work need to be done with these investee companies? So they really come together, setting the time-bound objectives, but also tracking and publicly disclosing progress about these time-bound objectives for engagement. So another key area of development that we've observed is accountability. The great first step, though, is that asset managers today have clearly established governance frameworks for responsible investment. So all asset managers included in our tool cite who is responsible for implementing ESG. And in most cases, it's very positive to see that actually the board of the asset management firm is responsible for ESG practices and ESG strategy. However, further accountability can be driven thanks to ESG training. So investment staff today are more and more trained on ESG topics on a regular basis. However, there's less evidence about training senior management and board level on a regular basis on ESG topics. And that is quite of a gap because actually these senior levels within these organizations are those making the decisions on ESG integration. And the other element is also linking ESG performance with remuneration and doing so across the board. So for now, we've only seen the Europeans starting to do so. So none of the Asians are at least publicly disclosing on these remuneration mechanisms. And so this is definitely an area of progress to close the loop of accountability. So just to focus a little bit more on climate change, and it's great to see that most of you are actually already thinking of integrating climate change into investment decision making. What we are seeing, and for us, the key area of progress is really anchoring climate strategies to setting science-based targets and strengthening expectations towards investee companies. For example, most asset managers are now well beyond the point of recognizing climate change as a risk. They also already, as you mentioned in the poll, integrating climate change into investment decision making. Asset managers are also supporting key initiatives such as the TCFD, or they're also supporting key engagement platforms such as Climate Action 100+. I would, however, like to highlight two areas of progress. First one pertains to governance. So making sure that within these asset management firms, climate risk management and climate risk strategy is actually assigned to the board. The second element is aligning these climate expectations to investee companies. So for example, what we've observed in our data is that most asset managers actually don't have robust expectations towards their investee companies. So only 20% of the asset managers included in Respond expect portfolio companies to align their disclosures with the TCFD. And only 10% expect portfolio companies to set science-based targets for decarbonization. And this is really key when we think about the role asset managers play in driving change in the real economy. They won't be able to make this change in the real economy if these expectations aren't rolled out towards the entirety of their investee companies. What we also observe is that now asset managers have overarching responsible investment policies which cover engagement and voting and exclusion. However, where we do see an area of progress is having more specific approaches for high risk, high emitting sectors, such as the coal or the fossil fuel sectors. So here it's about having specific policies for these sectors with clear engagement and threshold targets as well. In terms of climate, the other element where we do see a big area for focus today, especially since the SBTI, for example, so the Science Based Target Initiative, published its methodology for financial institutions in late 2020, is for these asset managers to set science-based targets for decarbonization for their portfolio, so for their Scope 3 emissions. We really believe this is a good way to track progress by having disclosed these science-based targets, as well as intermediate milestones, so on a 5-year basis on how these asset managers are going to decarbonize and report against these clear milestones on climate decarbonization. Another element of progress is once again transparency. So I mentioned a couple of slides back that most asset managers support the TCFD recommendations. However, there's a drop when you look at asset managers actually disclosing a TCFD report for their own activities and their portfolios. So this is definitely an area of progress that we see, especially amongst Asian asset managers. So now that we've touched upon climate, I think it's also very interesting to highlight nature loss and biodiversity loss. So you've mentioned in the poll just now that you are starting to integrate these elements also in investment decision making, with deforestation being one of the highest percentage of people who replied in the poll. So we see a little bit the same patterns from climate to nature loss. Asset managers today, especially Europeans and Japanese, are recognizing nature loss as a risk. So that's a given, I would say. However, the same lack happens when it's about translating these strategies, these high-level commitments into expectations for investee companies. So if we take water risk, most asset managers today would consider water risk when making investment decision making. However, only 13% actually translate these into expectations on water stewardship for companies operating in highly intensive water sectors. And we see also the same pattern for deforestation and biodiversity loss. So most asset managers do consider these elements when making investment decision making. However, this doesn't translate in expectations towards investee companies to set multi-stakeholder sustainability standards such as RSPO, FSC, etc. And then finally, on ocean sustainability, I think this is quite close to what you've answered actually in the poll, is that this is the least developed area for asset management industry today. So we only have a very little amount of asset managers who are considering ocean sustainability when making decisions and when building portfolios and when engaging with companies. And this is quite an important topic for our region, which is highly dependent on fisheries, but also coastal and marine tourism, etc. So this is an area also of progress for the asset management industry. So just to recap, before we open the floor to questions, areas of progress and recommendations would definitely be strengthen ownership practices, further develop governance through better training and linking it to incentives and remuneration, anchor climate strategies on science-based targets for your portfolio, as well as robust expectations towards your investee companies. And the final point is expand the climate focus to nature loss, including topics such as water risk, biodiversity, but also ocean sustainability. So I guess we can take some questions. I tried to catch up a little bit the time.
Yeah. Thanks for that, Marie. Really useful information, and really thankful that you shared more about your Respond work and all the gathered knowledge on how the asset managers in Asia perform and disclose vis-a-vis the European counterparts on time-bound objectives, engagement progress, TCFD aligned reporting, etc. So that is very useful. We do have a question from the audience for you. And the question is, does Marie have insights as to why active ownership is lower in rest of Asia versus Japan?
Yeah, so I think there's, I would say, two elements to it. First one is lack of, I think, overall transparency. So asset managers in Asia would maybe engage with portfolio companies, but not necessarily be very transparent about these engagement processes. So not disclosing these engagement practices and not participating into public collective engagement platforms. So that's, I guess, the first point. The second point, I think, is also lack of capacity and resources. So having these asset managers either being smaller in size or having started their responsible investment journey a little bit later than their European or Japanese peers would have less developed engagement strategies, leading down the line to less engagement with these portfolio companies. But I would like to insist on the fact that in Asia, in the Asian market, engagement is crucial, because if you are going to only have responsible investment strategies around screening and exclusion, it's going to be difficult to do that in an Asian market. So Asia is a region that needs help to transition, and that needs financing to transition. So that's where we see engagement being so useful in this part of the world.
Okay. Thank you for that, Marie. I'll let you carry on with the rest of your polling. And
Yeah,
if we have any other question for Marie, please send it through the chat.
Sure. Yeah, so while we maybe wait for a couple more questions, we did have another poll just to actually collect feedback on our session today and see how we can better improve these sessions in the future. So yeah, happy to get your thoughts. I think these polls are anonymous anyway, so you just feel free to just share your candid feedback. So I think there's 2 questions for this last poll. One on our tool, and then the second one on the overall session on responsible investment. So I'll just leave you a couple of seconds to answer that as well. Great, I think the second question is up. So you can also answer. I'll leave you a couple of seconds as well. Okay, great. So I guess, yeah, Sonal, this was all from my end.
Thank you so much, Marie, for your time and for providing us all the knowledge through your respond work. Without further ado, our next speaker is Daniel Ang. Daniel is an investment manager on the Asian equities team at Aberdeen Standard Investments. He's responsible for covering Asian equities and ESG at Aberdeen. In his presentation titled Operationalizing Sustainability in Investments, Daniel will talk about how full-fledged sustainable investing and environmental and social risk management looks like in real life, and what are the key considerations and challenges at each stage. I would not take any more of the time and pass on to Daniel and request the audience to keep submitting questions through the chat. Daniel, you now have control of the slides.
Thank you. Firstly, I'd like to say a very good afternoon to everyone. I hope everyone is safe and well. I also like to express my thanks to JC3 for inviting me to speak. So today, as Sonal explained, I'll be speaking about how we operationalize sustainability in investment processes and approaches to ESG investment. So we'll jump right into it. So before I start talking about the investment process, I think it would be good to provide some context as to what is ESG. So when we speak about ESG, ESG really refers to environmental, social, and governance factors, right? And E factors include the following, as you can see on the slide. But generally, E factors would impact the company's relationship with the natural environment. So an example would be, for example, BP's Deepwater Horizon spill or BHP's tailings dam failure in Brazil. So those are E factors. Social factors would include companies' behavior and attitudes towards customers, employees, local communities, and also includes topics such as human and labor rights, which is a really hot topic right now. So generally, S factors would impact the company's relationship with society. And what we're seeing currently is increased scrutiny, as mentioned, on modern day slavery. That is an example of an S factor. And G factors, governance factors, and this is probably the factor that most of us here would be most familiar with. And these factors include the forms and dynamics of company ownership, management, performance, as well as incentives, and fair and equitable treatment of shareholders. So ultimately, in G factors, we're looking to look for fair and equitable treatment of shareholders. And generally, the G factors will impact the company's relationship with investors. So for example, corporate structures like VIEs or incentive packages are examples of G factors. I think it's important to remember that we do not silo risks into one of E, S, or G, because there's very rarely a risk or an opportunity that is purely or solely just E, S, or G. It's very commonly a combination of both, or sometimes all three, right? So what are the approaches to ESG investing? Now, this table is actually taken from the UN PRI. I think it's a really good overview on the approaches that we can take when we're talking about ESG investing. So I'll spend some time here explaining the approaches, as it's important to understand the various approaches. So the best way to explain and think about it is in terms of process versus outcomes. So on the left here, starting on the left, you have ESG integration. I'll spend a bit more time later on speaking about ESG integration and how we do it at ASI. But generally, this is the systematic and explicit analysis of ESG issues alongside traditional financial analysis. So on top of looking at a company's fundamentals like its strategy or balance sheet management, this would involve analysts looking at how it manages its most material ESG risks and opportunities. And this relates to the investment process, right? So we are not looking to achieve a specific ESG outcome with integration. As part of the process, there may be ESG outcomes, but it's not the primary objective. And it's important to note that integration is not meant to be a box-ticking exercise. Next, we have screening. So this is quite straightforward compared to integration. Really, you're just excluding sectors or companies that you are not looking to invest in, right? And this specifically relates to an outcome, right? So you're not looking to invest, for example, in alcohol or tobacco or gambling. It could also relate to values-based exclusions, but generally the term socially responsible investing out there, which is quite common nowadays, SRI funds would exclude alcohol, tobacco, coal, and as well as weapons. This is just an example. And I think it's important to note the difference here with integration, right? The integration, you could, for example, choose to invest in alcohol or tobacco. But as part of integration, ESG integration, it would mean looking at how companies are managing their ESG risks and opportunities. And for example, for alcohol company, alcohol producer, this could come in the form of water risk, water supply risk, or supply chain management, for example. So I think it's important to note the difference between integration and screening. Next, we also have thematic or impact approaches. This approach seeks to combine a financial approach with a sustainability-linked outcome. So for example, this approach could invest in themes or assets specific to clean energy or sustainable agriculture. And with impact, you're not focused on a specific theme, but instead you're aiming to target your investments at solving certain ESG issues. With thematic and impact approaches, I think it's important to note that both approaches require detailed reporting in terms of the impact made or the theme that the companies you're investing in is aligned to. So on these different approaches, these three different approaches, it's important to note that they are not exclusive approaches, right? So ESG integration could and should probably apply across all the funds that you're managing, because this is a process rather than an outcome. And for funds that undertake screening, you can also have ESG integrated into the process. Similarly, for thematic and impact funds, you could target investments according to a specific theme or specific impact, but there can also be ESG integration in the process. So it's important to remember that integration is a process and involves looking at the ESG risks and opportunities alongside traditional financial or fundamental analysis. So try not to silo approaches into one single approach, either integration, screening, or thematic/impact. Alongside these approaches, on the right, you can see there are tools that asset managers can use, right? These are engagement and proxy voting. I'll talk a bit more about engagement later on, but generally, engagement and proxy voting, this is just the use of shareholder power to influence corporate behavior through direct corporate dialogue, there's engagement, or through filing shareholder proposals or voting that is guided by ESG guidelines. So why is ESG an accelerating trend? I think simply put, clients are demanding it, right? This is a secular trend. Globally, we are seeing that ESG funds have taken $84 out of every net $100 flow into equity funds in the last 2 years. And the AUM of ESG investment products alone is now above 1.7 trillion US dollars. And this was boosted by an almost 30% jump in the fourth quarter of last year alone. Asia has generally been seen to be a laggard on ESG, but even in Asia, 62% of asset owners now say that they seek information on ESG integration from their managers. And more significantly, 69% of them are saying that they will choose integration within the investment decision-making process. So put simply, around the globe, clients are demanding ESG. Now, what is driving this trend of this demand for ESG? So regulation is a big push factor, right? Government and policymaker interest in sustainable finance and investment has grown dramatically since 1970. So this is a chart taken from the UN PRI regulation database. And of the policies identified by the UN PRI, 95% have been developed since the year 2000. And this pace continues to increase, right? The PRI has identified 124 new or revised policy instruments in 2020 alone. And this is the highest number so far, and 32 more than the previous year. So as a result of this, what we're seeing is that expectations of asset owners are changing as well. Every single client meeting that ASI does would involve discussion on ESG, and more specifically on how ASI does ESG and how we're integrating it into our process. There's thus what we're seeing, a trickle-down effect, right? Boards and management of companies now, they know that they have to address sustainability and ESG issues, or they would face the risk of reputational and brand damage, or financial cost and impact to share price if there's a risk that's not managed adequately. So companies are starting to increase disclosure and formulate more policies, and the front runners of companies are those that are really who are able to not just state their intentions in terms of ESG, but they are also able to articulate a pathway to achieving their targets. Another contribution, I guess, or another reason is on performance. Now, this slide really, I think I put it here more of an FYI really, but because there are quite a few studies on ESG and performance out there. But in this study done by MSCI, MSCI research showed that MSCI ESG scores in the highest quintile would outperform those with the lower ratings. So now we move on to how we do ESG integration and how we do it at ASI. So I hope the following slides will give you an idea of how we do it and give you an idea on how to operationalize sustainability in the investment process. But simply put, this is ASI's ESG investment philosophy, right? We believe that comprehensive assessment of environmental, social, and governance ESG factors, combined with the constructive company engagement, would lead to better client outcomes, because we believe that ESG factors are financially material and would impact corporate performance. Secondly, we also believe that understanding ESG risks and opportunities alongside other financial metrics would allow us to make better investment decisions. And lastly, informed and constructive engagement helps to foster better companies by protecting and enhancing the value of our clients' investments. What does this really mean? So integration for us means that we don't just look at ESG factors alongside our fundamental analysis, but it's really part of our due diligence process. This stems from a recognition that ESG factors are financially material and would impact corporate performance. So this is not just ethics or values, right? But it's really a way of enhancing our understanding around the risks and opportunities surrounding a specific investment. So we want to get as much information as we can about how companies are managing these risks and opportunities across the board. And we believe this will help us make better decisions. So our approach is really focused on the company's management of its risk. However, we are not looking at the whole laundry list of risks and opportunities that a company faces. What we're looking for and what we're focused on really are identifying material risks to the company. So these are the risks that we believe have a real impact on the company's operations. So it's important to understand that these risks are constantly evolving and changing over time. So for example, a good example would be banks. When we talk about banks becoming more digital and pursuing digitalization as a strategy for the next leg of growth, then the risk of cybersecurity and data privacy becomes increasingly important for banks and becomes increasingly material. So this is something that requires oversight, and this would not have been the case 10 years ago. So risks are really dynamic, and it's important as investors for us to be dynamic in assessing these risks and to do so on an ongoing basis. Doing this, we believe, is a potential source of alpha, because by understanding how companies are managing their ESG risks and opportunities, it can help us identify long-term winners and losers. And that is, it can help us to understand the real sustainability and viability of a company's business model in the longer term. And this is particularly true for industries that are impacted by sustainability megatrends, for example, like climate change. And lastly, engaging directly with listed companies can drive positive change over time and can help build resilience and drive returns. I'll elaborate a bit more on engagement later on. So how does this look? How does this integration look like in the entire investment process? So when we do our pre-investment due diligence, we would consider a wide range of issues. For example, analysis of ownership structure. Right, we want to really figure out, are there any funnies in the corporate structure that could impact shareholders? We also look at business strategy and management. So does the company have the right people in place to execute the right strategy? We will look at financials, and also we'll look at corporate governance. And in corporate governance, we really want to understand what are the protection for minority shareholders. And also, of course, we'll look at the material, environmental and social issues that impact a company. So if we like the company and we initiate a position, our work does not stop there, and work should not stop there. Engagement as a tool is really powerful, right? It helps to protect and enhance the value of our investments. And it can help us communicate concerns that we have on relevant issues that the company may be facing. And it also helps to establish and build relationship with the company. And hopefully it can help to drive change where it's needed, and improve internal and external reporting, and improve its standing in amongst international investors. So after engagement, we would of course be constantly re-evaluating our thesis, which of course would include evaluating on an ongoing basis how a company is managing their ESG risks and opportunities. So when we're looking at ESG integration, we should try and aim to have it throughout the entire investment process. And I believe that it can be a very powerful tool in really helping to drive change and to protect the value of investments. So if we look at the overview of this process, right, we'll be looking, when we're analyzing things, we'll be asking things like, what's the company's risk management system? And we'll be considering whether the company actually understands its material risks, how the company is managing these risks. What does the future of this risk look like? And has the company considered future trends and business opportunities? And engagement really, it could be a wide range of issues, but typically you'll be engaging on corporate strategy and governance, capital allocation, and areas of weaknesses and potential areas for improvements. So these are some potential ESG issues that are quite common and we quite commonly look at. Most of these, if you notice, actually are really operational issues, right? So the point to be made on this slide is that it's important not to get caught up in the classification on whether it is a ESG issue or whether it's a fundamental issue, right? If you think about it, the real material ESG issues that are identified are fundamental to the company. There's no two ways about it, right? If it's an important issue, it should be analyzed and talked and discussed with the company. So these are some of the risks that we would analyze and discuss. So for example, for supply chain, typical questions here we ask, who audits the supply chain? How often are they audited? Right? The level of the audit, are they able to get a certain level of transparency within the supply chain? Do they help to educate suppliers? And how is there a supplier code of conduct, and how often is the supplier code of conduct updated? With product liability, this really relates to the relationship with customers. Are companies' products sustainable in its use? How does it affect consumers? How do they ensure quality control? Right? These are important questions to be asked with regards to product liability. If we look at human capital, and this is a hot topic right now, this essentially boils down to whether a company is treating employees correctly. Are they treating employees well? Are they incentivizing them correctly? And this also has repercussions down the road. If a company has a reputation of not treating employees well, it could find it difficult to attract new ones in the future. With corporate governance, this really boils down to whether we trust management, right? So asking yourself whether you trust the management of the company you're investing in, whether the company has the right people in place to execute the right strategy, whether there's a history of treating minority shareholders right. And we would not invest in a company if you're uncomfortable with management. With environmental responsibility, this is the relationship with the natural environment. So how does the company manage waste and emissions? How much are they investing to improve waste management and emissions? So it's important to have a think around these issues. And lastly, with business responsibility, things like, are companies conducting their business with the right practices and with the right ethics? Does the company have anti-corruption or anti-money laundering practices or policies in place? Are they effective? How do they measure effectiveness of these policies? And are there appropriate whistleblowing channels in place? And are they working? So these are some of the issues that we would analyze. And while it's ideal that all companies would disclose their activity on all ESG issues, the lack of disclosure does not mean that the company is not doing anything. I think this is an important point to make, right? If a company is not disclosing something, it does not mean it's not doing anything. And this is an important consideration because and that's where engagement comes in. So when we look at engagement, it's really a very key tool in terms of operationalizing sustainability, and it takes up a lot of time actually. So when we look at research, two of the most common challenges with ESG research, I guess, are inconsistencies in scores and ratings by third-party providers. Another one is poor disclosure by companies, as I mentioned before. So engagement is really an important way in taking advantage of this. If we just rely on third-party provider data to make decisions, the truth is you'd just be accessing consensus insights, right? Furthermore, third-party ESG scores are lagging indicators. So to be adding value, what we want to be looking for is non-consensus insight, right? And engagement can help it that way. It's a way of driving positive change in corporate behavior, mitigating risks, and ultimately improving performance. And because engagement produces a more in-depth understanding of a company's management of ESG risks and opportunities on top of what is disclosed or is not disclosed. So for example, a very simplistic engagement could be on disclosure. Third-party providers largely rely on disclosed data to make their assessment of companies. So companies could get penalized for the lack of disclosure, and thus this would result in a poor score for the company. However, the lack of disclosure does not mean that the company is not doing anything. So if you just blindly follow third-party data, this would create a blind spot. So if you go to a company, you can ask them specifically what they're doing around, for example, their supply chain or how they're managing climate change. You might be able to get a lot more information on that as compared to what you read in third-party scores and reports. So the final point is that investing in ESG improvers is where the power is at. And this makes sense because ESG leaders are generally well known, right? But the interesting thing is in identifying companies that are on the road to improvement and benefiting from the process as they make improvements. And you could really only do that if you have extensive engagement with companies. Bernstein research actually found that the alpha generation potential is likely greater for investors who are able to identify ESG improvement stories before they are reflected in scores. So engagement can help us to do that, because you get closer to the company and you understand how the company is better managing risks and opportunities on top of what is disclosed by third-party providers. So this all sounds good, but the truth is that engagement is not easy. This is the challenge that we'll face all the time. And no matter how long we've been doing engagement, this is the challenge, right? Engagement takes trust, and it takes time, and it takes tenacity, right? It takes trust because companies and investors need to develop a level of trust and mutual understanding in order for engagement to work. So this means that actually engagement takes time, right? We cannot see engagement as just a targeted, discrete activity, one-time activity. So there are many times where single meetings with companies can feel really uneventful or and provide little to no value. And this means that engagement requires tenacity, right? It needs to be part of a longer discussion with a company, with points continually and appropriately raised in successive meetings. So at the end of the day, the point to be made is that engagement needs to be part of the investment process, but more importantly, it needs to be a focus on performance rather than conformance, right? So it shouldn't be a box ticking exercise when you're doing engagement. So for example, if really you are looking at just asking about earnings or forecast for the year, instead of asking these box ticking questions, ask instead about strategy, right? Instead of asking if a company has a labor policy, ask how they are implementing the policy and how they measure performance of the policy. So other questions like, does the company have an independent board? Instead of asking that, ask yourself if the independent directors on the board are really independent. What is the skill set they bring to the board? And in engagement, really focus on performance and asking questions that help you to form a view on how the company manages risks, rather than just ticking off KPIs. So these are some of the findings that we have found, right, in doing engagement. And some of you may have experienced the same thing. But generally, I mean, the point to be made here is that I think it's positive that companies are being more open to engagement in Asia. While it requires time, it requires relationship. At the end of the day, companies are being more open to discussions and are increasingly receptive to ideas to improve performance. So this part is on engagement, and this next section on considerations and challenges, I hope this would be the most useful portion of the presentation for everyone, and it's the last portion in the presentation that I have. But there are three main things here, right? In screening, we should think about impact. In integration, we should think about structure. In engagement, we should think about performance. What do I mean when I put out these 3 points? So in screening obviously means you're not going to invest in certain sectors. But in deciding what to screen out, we should be aware of the impact. We should think about what we are screening out, because we can't always be screening everything out. And this is especially true in Asia. Because if you're screening everything out, this means that you have no power to encourage better corporate behavior through engagement. So it's important to think about the transition angle as well. For example, when we think of natural gas as a transition fuel, screening out fossil fuels would exclude natural gas investments. But it is worth thinking about the role natural gas can play as a transition fuel. So when we look at screening, a practical consideration on top of that is to consider how you do screening. It's typically done, typically you would reference a third-party ESG data provider, and it's typically done on a revenue contribution basis. But we need to be wary of the level of transparency in terms of the screening. Are all subsidiaries covered in the company, for example? And if companies are not covered by the third-party provider, then really you would have to do the work yourself, right? Because there's no data on the company. So these are some practical considerations when doing screening. It is relatively straightforward. It's not a difficult process. But I think the most important point to be made here is really to think about the impact you're trying to achieve when you're doing screening, and whether it's more constructive to be engaging a company. In terms of integration, it's important to think about the structure of integration. Right? What do I mean by this? Does ESG function a separate team? Is the ESG champion just a gatekeeper, or do analysts really undertake ESG analysis themselves? This is important because it's really hard to be integrated if these functions are separate, because it's really hard to incorporate ESG quality into stock recommendations or portfolio construction if the function is a separate function entirely. It's also a really difficult job for the ESG champion, because if analysts are just going to ESG champion and asking if they, yes or no, can I invest in this? It's a difficult job and does not foster collaboration, and it does not foster the production of better insights. So have a think about the structure you want to implement when you're doing ESG integration, because this influences the outcome quite drastically. Of course, the ideal picture of integration is the analysts themselves undertaking the ESG analysis in their stock analysis. But this, of course, will come with its own challenges, because it would take some time for analysts to become more familiar with ESG risks and opportunities in the sectors that they cover. So there's a learning curve of sorts there. And lastly, and most importantly, when we're talking about engagement, think about the performance instead of conformance. So avoid box-ticking exercises and box-ticking questions, and also avoid using the same brush to paint all companies, because be aware there are many nuances involved when we're investing. So instead of focusing on the regulations themselves, focus on the spirit of regulations. For example, family-owned companies are very common in Asia, and boards of family-owned companies may not be majority independent. Can we say that because of this, performance is poor, will be poor, or should we penalize it because of that? I think it's important not to use the same paintbrush and paint all companies, right? It's important to speak to the company and understand the strategy and what have they put in place to ensure that the board functions properly. Have they put in place a wider diversity of skill sets which will enable it to function properly? Are the committees in place and functioning? So these are questions to ask instead of just using the same brush to paint all the companies. Investing in alongside a family actually there's aligned with you, can actually be a very powerful tool. So this means really putting in the hard work of meeting the company, right? In general, meeting the chairman if you could, board members, management, doing cross-check, third-party checks. So it's really important to do the work yourself in engagement, and it's not easy, but it would produce better results. Also in engagement, I think it's important not to be afraid to set expectations, right? In engagement, when you're speaking to companies, don't be afraid to set expectations. If you want change, set out clearly the ask that you're asking from the company. What is the change that you would like to see from the company? If you want, you could even set a timeline on it. And don't be afraid to reinforce the point. If you had a meeting with the company, don't be afraid to send a follow-up email reiterating, all right, these are points that we'd like to see the company undertake, and we believe these are good strategies that a company can undertake to improve performance. So at the end of the day, there are really two types of engagements that we could categorize engagements into. The first type really is to ensure that good companies remain good companies. And these are engagements going in there. It could be a simple question: oh, how's everything going? Understanding what's it doing in the current environment. But the second type of engagement is to try and encourage positive change in companies that have been a bit naughty, right? And try and improve performance there. In both cases, the focus should be purely on performance, right? Instead of a box-ticking exercise, like does the company have an independent board? Yes or no? These are questions that should be avoided. Instead, take a further step to think about how the company is managing its risks and opportunities, and ask questions to get that from the company. So another big point when we think about engagement is really in terms of disclosure and comparability. And this is a challenge that I've mentioned, right? And this is a challenge you might face when doing the research. That is, there might be a lack of disclosure. So getting companies to disclose more about performance is important. because this helps you to track the performance of the company, right? If the company say they have a certain policy, but does not disclose how they perform or are tracking according to their policy, then it's important and it's really hard to get a sense of performance and actual on the ground implementation of the policies. How are these policies being implemented on the ground? Is there buy-in from management or employees on the ground? So it's important. If disclosure is a challenge and will be a challenge, but don't be afraid to ask companies to disclose more. And lastly, the final point I would make on engagement really is to track the progress of your engagement. After the engagement, just don't just leave it there, but track the progress of engagement, and getting performance updates from the company is a good way of doing that. But a simple tool like a spreadsheet to track the date of engagement, what was discussed, what did you ask of the company, and what was the company's response, this would suffice, and it helped to keep a log of all the engagements that you're doing. And this could also help you to identify potential engagements for other companies that you may be invested in. So this is really all I have for today. I hope it's been useful. I think we have some time for questions.
Yeah, thanks. Thank you, Daniel, for sharing in detail about screening and selection, monitoring, engagement, and exclusions. It was really useful, and I can see some comments in the chat box saying that you have raised some very valid points that other asset managers in the room identify with. So thank you very much for that. Yes, we have some time for questions, and I do have one question from the audience for you. The question I think makes a lot of sense and would be useful to get your inputs on that. So the question is, does the ASI process sometimes come up with a different rating from the likes of FTSE, MSCI, ISS? And if so, which one do you follow?
Right. So good question. So yes, the simple answer is yes. Even within amongst third-party providers, they might come up with different ratings for the companies that they cover. And certainly within our own due diligence on companies, we would come up with a different could come up with a different rating from the likes of third-party providers. This is common because if you're as close to the company as we are, we would have a better understanding of the companies. So therein lies the part about the asymmetry of information, right? Most of the third-party providers would rely on disclosed data. But if you've been constantly engaging and speaking to the company, you might understand and find out more about what the company is doing to manage ESG risks and opportunities. So I wouldn't be afraid if when you're doing analysis or when you're going through the process of doing your ESG analysis that you come up with a different understanding or rating from the third-party providers. And in this case, we would follow our own analysis, right? The third-party provider is useful in trying to figure out what, as a sense check of sorts, have we missed out anything on disclosure where the company could improve on? But at the end of the day, we trust our own process, and we would follow our own analysis rather than the third. We wouldn't rely on the third-party providers.
Yep, makes sense, Daniel. So because we still have 5 minutes before our scheduled break, I would like an opportunity to ask you a follow-up question. So there are multiple, third-party providers on ESG rating, etc. How typically, or say true for ASI, how many do you subscribe to? How do you choose which one to go for? Because every asset managers do have their internal team to rate on ESG, but seeing a trend on subscribing to these third-party data providers as well. But which one do you go for? How many do you go for is also becoming a key decision when you are doing your ESG work.
Sure. So I think when we look at third-party providers, because we do rely more on our own internal analysis. So we really only have one external third-party provider. But I think it really depends when you're looking to subscribe to one of these providers to look at the requirements and what they can offer offer you. Of course, when I mean, as with all third-party providers, cost is also an issue. You have to see if it fits your process and fits fits the purposes that you want it for, to use it for. But at the end of the day, I think it's useful to think about what you want to achieve out of the structure that you're implementing first, right? And then think about speaking to the providers and see how they fit into that process. Because there can be many, and I can understand it can be confusing. But at the end of the day, trust your own analysis and start with just doing a simple ESG analysis, and you get a better sense of which providers can help to fill that gap, right? Like I said, for us, we really use it more as a sense check to figure out what are some of the spots that companies may have missed in terms of disclosure or in terms of screening, as well as in terms of controversies, right? A lot of the third-party providers would provide these services in terms of flagging for controversies that a company faces. So yeah, I think it really depends at the end of the day what you want to use it for. So that's how I would approach it.
Thanks, Daniel. And before I let you go, we have one more question from the audience, if you could quickly answer. The question is that for a company with minimal or unclear disclosures, how would you rate them in the ENS pillar when all they mentioned is that they need time to compile the relevant information?
Great question.
What next steps would you take?
Great question. Well, so this is common in Asia, right? And it can be very difficult. Say from just waiting for them to compile the relevant information. I think a very good starting point for any asset manager looking to start an engagement or start research on ESG research on the company is to start with the governance portion, right? We're all familiar with governance structures, but asking the company how do they, I mean, is, for example, who has oversight on ENS issues at the company? These are questions that can be answered without the company having to compile information, right? It's a simple question on who has oversight on ENS issues at the company. Is it the board? Does the CEO have oversight, or is there a separate team that has oversight? And then move towards asking them how seriously they take these issues, right? If they say, oh yeah, we do have a team, or the CEO does have oversight on ENS issues, for example, on carbon emissions, then the next question to ask would be, well, then if that is important to the company, does the CEO have a KPI that's linked to the company's performance on carbon emissions? This will give you a sense of how seriously the company is taking the ENS issues, right? So I think a very good starting point for companies is to really start with the G, asking on how the structure manages the ENS portion, risk management in the company. So that's a good starting point, asking about the G.
Thanks, Daniel. And if you don't mind, I'll just try to squeeze this last one in. Don't you think that some countries are using ESG unfairly as a trade barrier?
Well, this is quite a relevant question given at the times, and for example, we're looking at when we look at modern day slavery, and when we look at how the usage of foreign labor in a company's operations. The truth is, I think that the truth is somewhere in the middle, right? We've seen a lot of activists coming up to in a sense whistleblow on companies, saying that they treat foreign labor poorly, and at the same time, companies are saying that they don't, and that they comply with all local laws in terms of treatment of labor. Well, that might be true. I think at the end of the day, the truth is somewhere in the middle, right? Activists do play a role, and I don't want to dismiss them, but they do play a role in helping to uncover certain issues. So it does not hurt to speak to the activists themselves, right? Engage the activists themselves, ask them what are the issues that they have discovered at companies, and at the end of the day, the real problem is, in a sense, the disconnect. For example, especially so in Asia, the disconnect between local standards and international standards. And there will be some time needed for Asian companies to catch up to international standards. So I would say it's unfair to expect Asian companies to comply with international standards right now, immediately, which is what activists would demand, right? And that's where the role of investors come in, right? I think we can be a good conduit between both in terms of managing expectations. So we've spoken to companies before on these issues, and we always tell the companies that yes, we do understand that you are in accordance with local laws. That's fine, but consider international standards. Have a think, right? We're not asking them to implement them right now, this instance, but have a think. Do scenario analysis, for example. How would this affect your operations? How would it change the way you operate? And is that something that the company can work with? So that's a really interesting question.
Yeah. Thanks, Daniel. Thanks for your views and thanks for the very informative presentation. Thanks for your time today.
Thank you.
Thanks. So this brings us to the end of Daniel's presentation. We would now take a short break before moving on to the next topic. So it's 3:47. We can reconvene at 4 p.m. to start on our next topic. See you all in a bit. Now proceed with the rest of the agenda for the day. I hope you had a chance to stretch your legs or make that call that you're willing to do before. Please welcome our next speaker for this focus session, Louise Kooy-Henckel from Wellington Management. As a Managing Director of Equity Product Management, Louise helps lead the group's global team of investment directors, portfolio specialists, and product management analysts. Based in their London office, her focus is to help drive the firm's strategic initiatives in Europe, the Middle East, and Africa. For equities, Louise also served as an investment director responsible for a range of equity investment approaches for the clients in EMEA, and particular focus on impact investing. In the next 60 minutes, Louise will work through a case from end to end, putting on different hats and thinking through considerations at each stage, and thereafter help wrap the case and provide a discussion on insights. Before I pass the mic over to Louise, I encourage you to post as many questions or comments that you want to discuss with Louise in the Q&A time. Encourage you to do that through the chat box. Over to you, Louise. The control of slides is with you now.
Thank you so much, Sonal, for that kind introduction. And thank you also for inviting Wellington to take part in this flagship conference on climate change and really reinforcing the importance of having a sustainable future for all of us. And this is, of course, meant to be a practical breakout session, as Sonal said, and a case study. And we have approached this really in two ways. It is in part a case study on Wellington Management itself, so our sustainability journey so far. Most market participants are, I think, on some sort of sustainable investment journey, all with different starting points. And no one size fits all, and that really applies to asset managers and asset owners alike. So how we've gone about doing it at Wellington, I think, could be very useful for others to hear, and we can have some great discussion points about that. And so despite, I think, the journey being different for everybody, the one thing that is really important is being authentic in how we implement sustainability. It's really critical. And that's really been the true north in terms of what has guided Wellington on this journey. And you will hear more about this as we talk mission, vision, and values, as you can see up on the screen. The other thing that we are going to do today in the case study is sharing some real examples from our sustainable investment platform, both of how to embed sustainability into portfolios. So we're thinking sort of more micro level here, with some specific ESG research insights, and also how that's influenced actual investment decision. But before we get into all of that, let me do a quick introduction to Wellington management, so you know a little bit about us. So if we can move on to the next slide, please. So Wellington Management is really a large global asset management firm with 1.3 trillion US dollars in assets under management. And the firm history goes back to 1928. So it was established a long time ago. And today we really serve clients in lots of places, more than 2,300 clients in more than 60 countries worldwide. But I think what's somewhat unique for a firm of this size is the fact that we are a private partnership and we have 182 active partners at the firm. We also only manage money for a fee. In other words, asset management is the sole business activity for Wellington. And we are a multi-asset firm, so we cover equities, we have fixed income, and we've got alternatives as well. And we are, above all, research and investment led, and we have centralized research resources across macro, equities, credit, and ESG. We're going to hear lots more about that. And we don't have a CIO, and we are really structured as a community of investment boutique. And collaboration is a key characteristic of our firm's culture. So this very unique business model really means that we can take a very long-term view, both in our investments and how we run the business. And that's actually one of our keys to attracting and retaining talent. But that long-term view is also of crucial importance when we think about sustainable investments. And I'd like to just introduce you to a couple of key points about that sustainable investment journey on the next page. And I'm not going to take you through everything here because there's a lot. But really our firm's sustainable investing effort started back in the 1970s with what we call our future themes. And it wasn't called sustainable investing then, of course, but we can tie the projects to the future themes collaboration. And this is really something we do about every 7 to 10 years at the firm. And it's research collaboration. And we ask all of our investors and researchers to stop what they're doing and just think for a few days holistically and look out 10 years into the future and think about what's coming and how that's influencing how we're investing and what's important. And really by thinking out 10 years, you already think about what's sustainable from that perspective. So some of the topics that came up back in the 1970s were clean water. It was water access and scarcity, but also things like personalized medicine. And then we've been managing exclusionary portfolios for clients for 2 decades. And exclusion is something that is becoming a very hot topic again, if you like, in different ways. And then we established a dedicated research team for ESG back in 2011. So if you like, a much more targeted approach came into the firm about a decade ago. And then more recently in 2018, we did an exclusive research collaboration with the Woodwell Research Climate think tank, where we are focused on physical climate risk, which is something that differentiates us in the market. We are, of course, also signatories to a lot of different global initiatives, including the UN PRI, and we're also amongst the founders for the Net Asset Managers, Net Zero Initiative for Asset Managers. So that's something we're going to talk a little bit more about as well today. But let me move on and talk about some of the backdrop that has really shaped the strategy that we have implemented and how those themes have impacted what we have been doing. And I think the first and foremost things to say is that we are really seeing a paradigm shift in capital markets with sustainable investing. And sustainable investing is really worth getting right if we think about the business case for this. The leaders today enjoy competitive advantages that we think are going to be durable, and we want to be a leader. So the potential for growth is very significant, And there is also a significant risk of revenue loss. So there is really increased regulation globally, as we know, both on climate and on social issues. A lot of that has been accelerated by the Paris Agreement, but also by the pandemic that we have all lived through now for many, many months. And we are also seeing a really rapid increase in client expectations, particularly in the UK, in Europe and Australia, but it's spreading actually everywhere. And we think that expectations will rhyme, but implementation requirements will vary. And that means there's going to be a heightened accountability for our portfolio managers. And that increased sophistication of our clients will require more differentiated and deep dive research when it comes to ESG and sustainability. Some of the common themes that are really important to think about here, and that's across regulation and clients and even third-party assessors looking at Wellington as a firm and looking at others, is that there is a high degree of skepticism of large mainstream asset managers entering this space. And greenwashing is a term that you will hear a lot. And there's a shift in focus from measuring activity to measuring outcomes. There's an expectation of full transparency into stewardship and engagement practices. And there's an expansion to focus to all asset classes. And there's an increased push for climate action, which really includes this net zero commitment I talked about. So I think it's fair to say here that market standards are new and they're evolving. And in some cases, clients and regulators are actually setting the pace as opposed to the asset management industry setting its pace or setting the pace here. So what do we want to achieve as a firm? What's our vision? And let's move on to have a little bit of a look at that. So I mentioned that we wanted to be a leader. And more specifically, our vision is to be the premier partner for sustainable investment strategies. And we want to provide thought leadership to our clients. And we think that best in class, it starts with research. And we want to share that best in class with our clients. For sustainability investing, that really means a deep dive ESG and climate research that mitigates risk and that drives alpha across all asset classes. And that fits right into our mission to improve clients' outcomes. But if we think about vision and mission, then anchoring our sustainable investment strategy to our corporate purpose and embedding our values should give a big advantage. And we think it's the key to be high integrity. It's back to thinking about that skepticism around greenwashing. We certainly do not want that attached to our reputation. And I mentioned some of the values already around being research-driven and investment-led. And that really means that portfolios at Wellington are non-concessionary. It's value above values. But having no CIO or top-down directive as to how ESG and sustainability should be integrated beyond those common values, it really means that every team will integrate ESG and sustainable investing in a way that's intrinsic to that team's philosophy and process. And so we actually think that philosophy can differ and be high integrity at all portfolio levels. So we might have a portfolio that's high quality and compounding, which is philosophically aligned with perhaps ESG best in class ideas. Others will be focused on misalignment or inflection points. And that forward trajectory is improvement. So what you see on the slide here is really how the firm has thought about the different phases that it needed to go through, because enabling these outcomes for our clients and embedding ESG and sustainability across the firm has really meant a firm-wide mindset shift. And here the tone from the top is so important. It's where it starts. And sustainability and ESG has now been a strategic priority for the firm for the last 5 years. And we've established a cross-functional leadership to help mobilize the firm, to mobilize global resources, to evolve our infrastructure, really transforming all parts of the firm to support and undertake these activities. But importantly, all of it has started with education. And that has been the key to moving the firm along. And we are perhaps now more focused on the enhancing and the expanding parts of what we do at the firm. So if we move on and have a look at what we do on the sustainable platform today and where we've come to, really some more specifics. We have a number of different and complementary approaches. And this is important because we want asset owners to have as much choice as possible to implement their own sustainability programs. If we think about how many trillions of dollars that needs to be reallocated in terms of capital to achieve the United Nations sustainability goals, for example, then there's a lot of capital reallocation that needs to happen. So today, when we think about the different approaches, it really ranges from ESG integration and engagement to more narrow thematic investing, for example, investing through a gender lens, or perhaps focused on a single topic such as climate risk mitigation. Impact investing is a flagship strategy, now really a franchise for the firm, and now spans multiple asset classes. And we have been so encouraged to see the heightened understanding of impact investing and the take-up by asset owners here as well. Exclusion or negative screening is also a hot topic as well, and I think we'll probably get a few questions coming up in our discussions later on around that. Interestingly, though, is that our strategies can really incorporate any combination of these different approaches that you see here, and many typically do. And that means that return profiles vary, but all of them seek to outperform. Now, if we move on to the next page, where we have really showing with this goal of outperformance, if you like, looking at the sustainable investment continuum, or if you like, a simplified spectrum of capital. None of our investment portfolios are concessionary. They all come with the view to outperform. So there is no specific aim here of philanthropy. And why do I bring that up? Well, because it's really the first hurdle that we found in working with not only our internal portfolio managers, but also many asset owners. There was this inherent myth or bias that if you are investing and doing good, you must be giving up every time. And we have not found that in our investing experience today. And that's something that's taken a little bit of time to get educated around. But let's move on and have a look at our ESG implementation and why that is important. And we'll move on to some specific examples here as well. So we consider the ESG criteria as one set of factors amongst many that should really be sort of come together and be weighted appropriately to inform investment decision making. And our guiding principle here is that material ESG issues are business issues that will impact stock and bond price performance. And that, of course, in time will impact portfolio performance and portfolio returns. And ESG factors, it's of course not the only thing that's going to affect profitability or stock prices, but it can be an important piece to really understand how these factors can equal higher profitability. Like, why is it important to incorporate them? And we have a couple of examples here. For example, within the environmental part, for an energy exploration and production company, they tend to be very water intensive. So those companies that are better at managing their water consumption should have lower cost of capital. So that translates directly into the profitability of the business. Within the social piece, labor conflicts can be extremely costly and erode margins. And within the governance piece, for example, management compensation, where we find that people will usually do what they're incentivized to do. So we want to make sure that compensation is aligned with shareholder objectives and the business plan for a company. So materiality, which is key here, is really different for each sector. Not all ESG characteristics are equally important to each company or its sector. And we could, for example, see an underappreciation of climate risk in municipal bonds, which could cause investors to underestimate default risk and recovery rates. So materiality is key. And what's important differs by company and it differs by sector. And then in addition to thinking about integrating ESG factors using this materiality framework, we also practice active ownership through proxy voting and direct interaction with company management and boards. And again, that is very much guided by the materiality framework. So let's have a closer look at that materiality framework. So on the next page, you will see a couple of different examples here, the energy sector and the healthcare sector. We just looked at two to really sort of flesh out a little bit more detail how we think about it. So with materiality being the foundation of the ESG integration process, that's really because those ESG considerations are likely to impact the long-term value. And as I mentioned, they're not identical for every industry. Now, research that we have looked at suggests that companies that are focusing their strategy on addressing material ESG factors for their industry may outperform over the long term, while there is an implicit opportunity cost for companies that focus their efforts on immaterial factors. So in other words, if you are a company and you put your efforts into the things that are important for your industry, you should do a lot better than focusing on things that are not important for your industry. And you'd think that would be somewhat logical, but it's not necessarily how companies bear this out in practice. So you'll see here two examples with the energy sector and the healthcare sector, as I mentioned. And for energy, of course, the environmental sector is really, really important. So in the materiality framework, that E research gets a 50% weighting, whereas the G and the F are split equally on the other side, so 25% each. Now, the environmental piece is a lot less important for a healthcare company, but the social aspects and the governance of that company is really, really important. So we apply that same materiality lens to how our broader stewardship efforts around proxy voting and engagement strategies are articulated for the companies and for their sectors. So let's have a look at some of the details of how we can develop a materiality framework. And what we did at Wellington was to have a look at what the Sustainability Accounting Standards Board put out, so SASB. We then spoke to our analyst on the equity side, on ESG and on credit. And we incorporated all of their views and all of their experience and really combined lots of different perspectives in coming up with that materiality framework. And some of the things that we've looked at and how we've assessed them, if I pick out a couple of examples, again, within the environment, where here we focus very much on climate and energy management. So it's important from a cost perspective for a firm to avoid regulatory fines and costs associated with remediation. And so we've assessed that by looking at their energy consumption, their scenario analysis, their emissions, and we encourage companies to use the TCFD framework and commit to science-based targets around reducing their emissions. On the social side, the focus is all on human capital. And that can include diversity, it can include the company culture. And I think as one portfolio manager put it, it's always stuck with me, that one way she mentioned it, and she said, you know, understanding a company's culture really enables us to assess more accurately its management depth, risk controls, and the potential to innovate. And I think that sums it up really, really nicely. And on governance, we are very focused on board effectiveness. So what's the structure like for the board? And a key issue here, for example, is the separation of the chair and the CEO. And that's something that we have applied to Wellington management itself once we started working with all of our companies on them doing it. So that was an interesting internal development that was born directly out of our ESG research. So let's look at a couple of examples. I chose one here from on the E side, from the oil and gas sector. And I think this is very topical given the focus of the conference on climate and sustainability. And so here, the ESG issue really is around two large exploration and production companies in the oil and gas sector. And I think that most scenarios now used by the energy sector really shows fossil fuels losing a share to carbon-free energy sources. Increasingly, and that's very positive, we're seeing oil and gas companies that are aligning their long-term strategies with the energy transition. But some are really falling behind, and it's difficult for them. It's their business, but they also need to get on board with how to best transition their businesses. And that, of course, requires investments, but it requires a lot more. So in our engagement with one of these E&P companies, we met with the CEO, we met with the CFO, and we met with the head of sustainability. And that engagement made a real difference for our view of that company versus some of the other companies in the sector. And what we were most struck by with this company was that the CEO had incredibly strong conviction in the company's strategy, but it was coupled with self-awareness of the company's strength and their skill gaps. And they articulated a really thoughtful approach to credibly aligning with the energy transition while doing it on their own terms. And the actual outcome, this was really from our fixed income team, from our credit team, was that the credit portfolio manager added this company to his portfolio and sold out of the other company that he had an overweight in, that was really behind on this journey of aligning with the energy transition. So we can see how the ESG research around the issue and the actual engagement with the company reflects in the outcome of how this gets into the portfolios. We have another example here on the next page from the S piece. And this was really around human capital, specifically in sort of a merger environment. And this is an example from the UK. It's a records management and support services company that came up on our equity portfolios in European small cap. So we've gone completely to another asset class and a much smaller company versus a large company. And what we saw here was that at the initial investment, we found the environmental aspects of the business really attractive, and they had very good environmental management. It was also a company that was growing through an acquisition strategy. And through our holding period and through a lot more sort of, if you like, further scrutiny, we really began to pick up on very poor employee engagement. And we found that this was really impeding the progress within these acquired businesses that was quite a lot more labor-intensive businesses for this company. And when we quizzed the management around this, they were actually very dismissive, as if that was just what happens. Yes, we acquire a company, and yes, some won't like it, and yes, some won't fit into the culture, and if they leave, so what? Very, very dismissive. There wasn't any investment into understanding the labor force. There wasn't any ideas around engaging and improving the situation, or even really integrate the acquired businesses more. So this caused a lot of concerns for us, and we reduced the position significantly on the back of this engagement. And then actually what happened was, shortly thereafter, the CEO who we had met actually decided to retire and left the firm. And for us, that was a clear signal of that lack of engagement and lack of direction now for the company. And we ultimately completely sold out of this specific name. So engagement is really, really important, and it does drive specific outcomes. And if we move on to have a look about, or have a look at the sort of engagement piece and how that comes together and how we think about it, because there's lots of different ways of engaging with companies. And we think that the sort of active engagement with companies can support a company, but we're also looking to influence company behavior in a way that will ultimately benefit our clients and broader stakeholders. So it's important to note here that Wellington as a firm are what we call constructivist. We're not activist, and we actually prefer to have most of these conversations in private with companies, although from time to time we do join in broader initiatives with other shareholders. It's a huge advantage for us to be a large house. We get access to management teams and the board of directors, and we also have established and credible research, and many of the companies really respect that. And it's important to know that being an active manager is, again, very important, because other firms that have large passive books, they can obviously vote by proxy, but they're not active in that same way. So when we sit down with companies, they want us to own their shares, but we don't have to. We're owners by choice. But none of that matters really if we're not credible. And so bringing together our research, we can bring differentiated insights, and we can influence with our expertise. And that's something that we see again and again. Companies sometimes call us and they say, what do you think about this issue? We're thinking about that policy or this strategy. What's your view on that? What should we worry about? And that really shows the degree of trust that we have with management teams across many of the companies. And that's, again, really, really important. Being able to triangulate research, both from the equity side, from credit, and from ESG, to bring those interesting views to our companies. So let's have a look at board diversity on the next page. And I really just wanted to show this as, if you like, an example of sort of a diversity campaign that we've been running as a firm, working with our companies or investee companies now for several years. And this is a situation here where we took to letter writing. We asked companies to add female directors to their boards, and it's now been going on since 2017, so several years on. But the good news is that 82% of the companies have added at least one female director to their board. And I think this is important because it shows that engagement does work. It can really pay. But let's shift gears a little bit and move on to some thoughts around climate. And this is, again, bringing in some of that ESG and climate research into our portfolios and how we are using it. And we started a partnership with the Woodwell Climate Research Center in Massachusetts in the US back in 2018. And we really wanted to bring in the climate science research into how we think about capital markets and how we think about asset pricing. And Woodwell is a completely independent climate research think tank. They have 70 scientists working globally. And what we wanted to do here with them was to research specifically climate variables and bring that into the asset pricing side of things and understanding the opportunities and the risks better. And we looked at quite a few potential partners here, but we chose Woodwell because they're independent, they're fully resourced, and there was no risk of affiliations that would influence the research. And given that they're scientifically led, they're incredibly credible, they own our assumptions, and so we can then own the climate assumption we use with full transparency. So we have a broad framework in working with them, which focuses on 3 areas. The first is really defense. So assets that we may want to avoid in our portfolio or discount because of potential negative impact from climate change. For example, fixed location like a theme park. The second part was really one of offense. So are there assets and companies that may become more attractive due to climate change? And that perhaps is more focused around some adaptation, so backup power, engineering firms, for example. And then the third area was around engagement. So how can we assess and advance a company's preparedness and climate resilience? So again, that goes directly to some of the engagement pieces I just spoke about. So for investee companies in our portfolios, how can we get better informed to really understand how prepared they are and how we can influence them? So we focus on 6 climate variables in the research with Woodwell. That is really around heat and drought. We also look at hurricanes and floods, wildfire and water access. And it's a bit like thinking about taking these spatial maps we do and then understanding how that impacts a security. So we can map a security's physical locations. We then look at what are the impact of those 6 climate variables in that location. And what we have found very interestingly when we looked, for example, at municipal bonds that were priced the same and had all the same characteristics, but were in 2 different states in the US that had very different climate implications. They were priced the same, even though one had much, much more climate risk to it. So when we started doing this back in 2018, it became very clear to us that the market is actually not pricing in physical climate risk very well. And that's an opportunity, of course, in terms of how we work with our portfolios and how we work with our companies. But let's move on. I'm going to skip the next page in the interest of time and move on to talk about our net zero commitment. And the net zero commitment is something, again, I think is going to come up a lot throughout the conference. Wellington was one of a select number of founding members of the net zero asset commitment that was announced in December of 2020. And so net zero is now synonymous with achieving the Paris Agreement and limiting the global average temperature risk to 1.5 degrees. So as a firm, we recognize that climate change impacts companies and economies, and that we can enhance investment decisions when we use that climate science. So as a firm, we have committed to reduce emissions for the assets that we own and setting targets. So this is where we think about a glide path for our portfolios to decarbonization. We also have committed to engage with companies to set science-based targets and then review those targets consistently and regularly over time. Our preference as a house is engagement rather than divestment. And that's really because that if we engage with companies to encourage them to take on science-based targets, they in turn will decarbonize, and over time that won't just be scope 1 and scope 2 and scope 3 of emissions, it will also include scope 3 of emissions eventually. And so by going about it this way, we can influence and decarbonize the whole economy. Whereas if you divest, you cannot have the opportunity to influence and make that happen. So that is a key importance. And I think there might be some challenges around how that gets implemented, because some of our clients and some of the asset owners take a different view. So this is going to be very much a case by case situation where we work with each of our clients to understand how they want to in their portfolios. So let's have a look at what we've learned on the journey so far. I think, again, important to emphasize that everyone has a different starting point on this journey. And in some ways, the destination isn't really the important piece. It's the journey itself. And I think it's fair to say that one should expect skepticism, and education is key. And we've got to continue to educate. And there are huge challenges across different asset classes with the data, and we heard something about that in the previous session as well. But I think in time, the industry will begin to overcome some of those challenges. I think what's really positive around those data challenges is that if you do have a well-resourced house when it comes to research, you can really add value using that deep dive into fundamental research to help with external data provision, which might be quite flawed still. Now, there are pros and cons of Wellington's structure of having a no-CIO. It takes longer. It takes longer to build alignment from the bottom up across all of the investment team. But the bottom-up articulation is really important. It becomes more sustainable in the long term, because if each portfolio manager is articulating their ESG philosophy aligned with how they think about their portfolio, how they manage that money, and how it fits into the process, then in the long term, they will buy into it and be accountable for it, and they're going to want to push it forward. And that's very different than if you had a CIO top down that said, okay, everybody, this is how we're now going to integrate ESG. You'll probably get quite a lot of grumbles from several portfolio managers in such situations saying, well, that doesn't fit in with how I think about my investment philosophy and how my process is carried out. So I don't like that and I don't buy into it. So ultimately, we think it's a strength, but it takes longer. And so that really brings me on to the sort of, it might sound a little bit of a cliche here, I guess, but Rome wasn't built in one day. This really does take time. And it's really important to not let perfect get in the way of doing these things better and improving all the time. So with that, I think I want to wrap up with a couple of sort of conclusions around what we see here in the sustainable investment landscape, because it's moving really fast and it's hard to keep up. But there are a lot of inefficiencies, and it's great to be an active manager here, because we can add a lot of value through deep fundamental ESG research. And it also means that there is something that will fit into most asset managers' portfolio, asset owners' portfolios, sorry. And that's important because, again, we need a big capital reallocation to take place to meet the UN SDGs and to facilitate the energy transition. And everyone is on that journey again. It will require customization to implement, given everyone's starting point is different, with different objectives and different values. But I think above all, being authentic in this space really, really, really matters. It's important for how you implement, it's important for being credible, and it's really important for how clients perceive you and how you're perceived in the industry. So with that, I'm going to stop. I've seen lots of questions pop up on the right-hand side of my screen, which I think Sonal's going to help me with. Is that right, Sonal?
Yeah. First of all, thanks, Louise, for sharing your knowledge and experience through this case. Really insightful. My key takeaway from your presentation is that there is a clear motivation to address sustainability as a topic. You could achieve that distinctive value proposition for your fund management company by addressing sustainability while managing performance. And on that note, there is a question in the chat box which say sacrificing performance for ESG issues and a question mark. So what's your take on that?
Yeah, it's a question that has come up many times, and I think it continues to be an ongoing discussion. So when we started out of this on this journey and talking to asset owners and really clients around embedding sustainability in ESG research, there was almost an immediate reaction of, but hang on, if I start doing this, am I not going to be giving up the financial return of my portfolio? And I have a fiduciary duty to maximize the return for the portfolios in case of pension funds, for example. So how does that align with my fiduciary duty? So that's something where we've had to educate a lot around. And because you integrate ESG research and because you invest with sustainability in mind, does not mean that you have to sacrifice financial return. And I think some of that, if you like, the myth, it really comes from, I say, back in the day when we go back to the sort of early 2000s, when most of the space was focused on exclusionary processes. So where investment opportunity sets were really reduced, and that certainly did have an application in many cases and also had big structural biases. But I think we've come a long, long way in terms of the investment opportunities that are now available, and it's much richer. And so we spend a lot of time with our clients and asset owners, generally showing them that you don't have to give up return. And I think also now it's broadly considered part of fiduciary responsibility to incorporate ESG factors, and especially climate risk is at the forefront now for many, many clients.
Thanks, Louise. Thanks for that response. So on the topic of climate risk, there is a question from a fellow fund manager. Does Woodwell provide you with a selection of possible scenarios, how the climate might evolve, example, 2 degrees up or 3 degrees or 1 degree by 2050?
Yeah, so interestingly, we don't really use it at that sort of top level, if you like. We focus more around the implication at specific security level. So, for example, we might look at a company's physical location, see where they are, and then we look at the implication from the climate variables to see what will affect that specific location in terms of climate risk. So an interesting example was we had a company, this was a US company, that recently had built a huge factory in Louisiana in the US, spent a lot of money on that. And when we met with them and we talked to them about it, we had already done a bit of work around the location, and we saw that the probabilities there around hurricane, I mean, they're already known to have more hurricanes, but actually the probabilities of that going up and being more frequent and more violent hurricanes over the next decade was much, much higher. And we also forecast out beyond that. So when we went to speak to the company, we asked them about it. We said, have you thought about this? What have you done to protect the assets? What have you done to protect employees? how's your insurance policy? They hadn't thought about it at all. In the end, the portfolio manager and the analyst who engaged with this specific company actually sold the company on the back of that management interaction, because they just hadn't any awareness at all about this in their business and how to manage it. So it's more about probabilities for each of the climate variables, but we do also think about big picture. For example, in our climate research hub 2 weeks ago or so, we reviewed the entire Iberian Peninsula, so all of the Mediterranean in Europe, with a view of thinking about all of these countries have signed up to the Paris Agreement. How much land do they actually need for clean energy, to produce clean energy, and which countries are going to be better suited? And why is it that one country in the Mediterranean gets all the investment for solar power when another country is actually has much better probabilities or potential for solar power? So those are some of the things that we then bring down to the portfolio level. So what do we own in solar panels? What are the companies? What are the investments? And then again, it allows us to incorporate that into how we look at that investment and how we engage with the company. But I have lots of examples. So I'll stop there because I'm sure there's lots of other questions.
Yeah, so following up on your answer, there is a question which talks about whether you engage with companies, your investee companies or potential investee companies on a general direction basis only, or do you provide them advice and concrete suggestion, or engage with third party to provide technical insights?
Was the question specifically with a gender lens? Did I hear that correctly?
No. So when you engage with your investing companies, do you provide them a general direction only, or do you give them specific technical insights by engaging, say, third parties?
Yeah, we generally give them very specific insights, such as the example that I just shared with the climate piece and the company in Louisiana. I mean, that was very specific insights that we could share with them from our climate research. We made it very clear to them what the data showed and how it had been modeled in this case. So it tends to be very specific, and it's more driven by, I guess, our own proprietary research than it is by external providers. Now, obviously, Woodwell is external to Wellington, but we do have this joint research collaboration that we can use in the work.
Okay. Thanks for that, Louise. It was really insightful and really informative with real world examples. So thanks for your time. Thanks for joining us today here.
Thank you so much for having me. And it was a pleasure. And thank you for all the great questions. Enjoy the rest of the conference.
Thank you. So we are slightly ahead of our agenda, which is always good. We are saving time, which gives more time to the next speaker if required, or we could finish early. So without further ado, I would now like to welcome two next speakers from 2 Degrees Investing Initiative, Nicola Stefan Koch and Constanze Bayer. Nicola is co-managing the Retail Investing Research Program at 2DII. The goal of the transdisciplinary research program is to leverage retail investments to close sustainability funding gap in Europe. Constanze works mainly on retail investing team at 2DII. She was part of team that built up the online platform My Fair Money that helps retail investors to educate themselves on sustainable finance and climate performance of retail investment products. Her focus is on survey design and data analysis. In the next 30 minutes, the duo will talk about research findings on consumer preferences on sustainability based on 2DII findings in Europe and prevent misleading and marketing claims in Europe, which probably we can draw lessons from in Asia. Over to you, Nicola and Constanze. The floor is yours.
Thank you, Sonal, for the warm welcome. And good day from me also, and also from my colleague, Nicola. So first of all, thanks for the opportunity to be able to speak here at today's conference. And before we get to the topic that is announced, I would like to say a few words about who we are in at 2DII. As I said, we are both working for 2 Degrees Investing Initiative. We are a think tank that aims to align financial markets with climate goals. Our work is independent and not for profit. This is important to notice. And we are dividing our work in several research streams. There are 4 at hand. Number 1 is to look at alignment measurements with our own alignment measurement methodology. We are looking also at impact measurement, and we have a third long-term supervision program and a retail investor program. And in the next few minutes, as Sonal already announced, we will talk about some highlights from this retail investor program. So we will look at the growing importance of retail investors for the market of sustainable finance products. We will also explain why the products that are offered currently are unfit to meet the demand that is out there. And most importantly, and hopefully insightful, is how this situation can be improved. So the first half will be done by me, Constanze. I'm a senior analyst, as Sonal already explained, at 2DII, and the second half will be presented by Nicola, who is a deputy head of the retail investing program. If you have questions, I think you're all used to this by now, please send them via the chat function directing to all panelists, and we will answer as much as possible during the Q&A session at the end. So now I have to check the slides. Yes. So what we have seen in the past few years is that sustainable investing has reached ever new all-time highs. So the volume of sustainable finance products has grown in a quite impressive manner. And this is true whether we look on a worldwide level in the first graph on the upper left side of the slide, but also on a European level, which you can see on the upper right-hand side, and also on the level of a single country. Here we have numbers from Germany in the lower part of the slide. And while the overall share of sustainable funds and mandates still seems to be small, on an absolute level, it's growing. So we see in Germany a fraction of 6.4% in 2020 that are invested in sustainable funds and mandates. But this is already quite a bit more than the 5% that were reported a year before. So where does this growth come from? One factor in Europe is, of course, a political one that I think you are all aware of. So we see an increasing regulation in this direction by the European Union with the Sustainable Finance Action Plan and the regulation that followed this action plan, which is steering markets into offering these kind of products. In this environment, we've seen that retail investors have become really one of the main drivers of this development. I'll explain a pattern from Germany that we also see worldwide. So private investments are growing in an impressive way, as you can see on the left-hand side of this part of this graph. But they're growing even more than the institutional investors inflow, which is still increasing, but not on the same level. So just from 2019 to 20, the inflow into sustainable funds grew by 17% for retail investors. And that, of course, in the end leads also to a growing proportion of sustainable finance assets that are held by retail investors against those held by institutional investors. So in conclusion, it's really fair to say that the market for sustainable investments is growing and retail investors especially want to be a part of it. So there's a positive wave coming, but is this a development that is come to stay? We as an NGO would say, yes, this is here to stay, but the market needs to change in order to fulfill consumers' needs and wishes. In previous studies, we have seen a majority of consumers that are interested in sustainable finance products and that might take those products into consideration. Numbers rank about 60 to 70%. We have seen several motivations for these interests. One can be to have a real world impact. Approximately 15 to 40% of retail clients state that this is their motivation. We also see the wish to perform more symbolic actions and support, to do no harm, for example, via exclusion, and also to optimize returns via integrating ESG into financial products. What we've also seen, this interest is not only existing in clients that have already invested before, but also in clients who have not invested yet. So what we can see is that these clients bring a lot of money also to the table. Retail investors in Europe are estimated to hold, for example, approximately 30 trillion euros in financial assets. So this is an impressive market that needs to be served and that you would conclude will be served. So in here, I want to ask for your opinion. If you could please start the first poll that we have. You will see the question. What we did were mystery shoppings in several banks in France. And I want to know of you, what do you think had happened on average? Did advisors ask their clients about their sustainability preferences? You can choose between yes, they always did. Second answer is quick in the conversation, only after a few hints, only after heavy hints, or not at all. And I would like to give you some time to answer this question. So we really equipped several mystery shoppers to visit banks and to stage a conversation around a potential investment that they would like to make. And all the personas had an opportunity to answer that. So what we see is a quite a mixture between, can you see the results? I hope you can. What we see is a mixture between, yes, they answered quickly into the conversation after a first introductory chat, or not at all. Both hold about 20 to 26%. This is somehow close to the reality because, yes, what we've seen is retail clients are not asked for this very often. Mostly, it was never asked, even after they gave heavy hints. And the topic never came up without any hint. So it is not a standard question that is getting asked. There are several reasons that we see. Distributors are still lacking a good questionnaire to assess their clients' needs. So how do you ask for these kind of things? And also a lot of products that we also see, a lot of interests that are addressed are really diverse. So it's not that one client equals the other, and that there's also quite some mistrust. So of course, this leads to a risk of greenwashing that retail clients are aware of, and what they feel is that they're experiencing and reacting with a lot of mistrusts. So we really see problems from several sides. So advisors and fund managers are often blind to their clients' needs as they don't have the questionnaires and the tools at hand to address those sustainability issues. Then the products that they're offering are too broadly and they don't, they follow a one-size-fits-all manner, so they don't really fit the demand. And in some cases also the potential impact is overstated. Here I want to make a second poll. If you could open that one, please. There are several some marketing claims that we found regarding the CO2 footprint of a certain product. The second one with a comparison to real life, and one looking at exclusion topics. And I would like to know, which of these claims do you consider to be misleading for retail clients? Again, you have a short time to answer this. Please do so. I would be really happy if you take part in this. Which of them do you consider misleading? And a few seconds more maybe to grasp also the concepts that are behind them. Okay, I think we can close them. All of them is the majority of participants that took part, and that is about right. From a retail investor's perspective, most of the all of those claims are actually misleading. The first one because the first and the second one actually because they imply for a lot of retail investors we found in our research that actually GHG emissions are reduced on the ground, which is in the end what is not happening. And also even the topic of exclusion that seems to be fairly simple at the beginning is also not exactly the same for retail investors, because we always see revenue thresholds in these kind of examples, which is something that retail investors usually don't expect. So following this, we see there's a mismatch between what clients actually want and what they're offered, and then also buy. So we saw already the need for a real world impact where no evidence can be given so far. We see diverse interests that depend on a lot of factors, which one size fits all products cannot address. We see also a wish for a certain voting power in shareholder meetings, for which at the moment no mechanisms exist so far. And also the topic of exclusion, as I said, is one that is not fully compliant, at least from a retail investor's perspective, because for many retail investors, this becomes a matter of personal values, which leads to the wish of excluding a topic completely. Various fund managers are often more pragmatic. We've seen revenue thresholds, and also we see a difference in the scope of the value chain that is in the end excluded, and that is not intuitive to consumers. So we are really at a situation where we see this mismatch, where we see a lot of mistrust and the need for more honesty. And how we can grow out of this mismatch will now be presented by my colleague. Thank you.
You, Constanze. Could I become host so I can change the slides? Or please just move to the next slide. Okay, great. Yes, also a warm welcome from my side. I will lead you through the second part of this presentation. And I will try to now give you maybe some answers to the question how you can now surf this retail wave without crashing, according to our best knowledge and our research. On the one hand, we as an independent think tank, we are trying to identify shortcomings in the market, as you have heard in the previous presentation. But on the other hand, we are also providing tools and methodologies and research on potential solutions and provide guidance. To serve the retail wave, we identified 3 crucial steps which we would recommend to follow. So on the one hand, to understand what your clients really want, then to manage your sustainability as a financial institution, but also your product portfolio. And third, to promise only what you can hold. I will go into each of these steps individually. To understand what your clients really want is crucial from 2 aspects. So on the one hand, it is relevant to inform your product portfolio and your product designs. So to understand what your client base really thinks and really wants is a very, very relevant information. And on the other hand, also on your day-to-day business with your financial advisors and in the distribution of your products, how to assess the preferences in order to accordingly match the preferences with the products you have. And the first question you need to answer is the right elicitation format and methodology for the specific context. So for instance, to assess your client's preferences on a broader basis to inform your product design, there are several methodologies which try to minimize biases, which is the most complex task to understand your client's preferences. We know from behavioral science that there are several tools, fortunately, you can minimize these biases. For instance, our partner from Maastricht University works together with pension funds in UK and the Netherlands, where they apply a so-called investment gain methodology to assess the client's preferences of their sustainability criteria and whether they would accept also financial losses if these criteria are applied. Another really interesting and very innovative approach is from our partner from University of Zurich, who's applying natural language processing and where they apply artificial intelligence to assess large amounts of qualitative data through open text field analysis to assess where answers might be biased or not. We ourselves, we are conducting this year a series of quantitative surveys and qualitative interviews and focus groups across 14 different countries in Europe, covering 14,000 people, which will be one of the largest research activities on retail sustainability preferences in Europe. This is relevant to understand the client's preference more broadly, but how you can integrate sustainability questions in your day-to-day business of your financial advisors and your suitability questionnaires is another very complex topic where we are working extensively on, because as some of you might know, to integrate sustainability in this financial advice will be mandatory from summer next year on in Europe, according to the MiFID II regulation. And here, we would recommend, and as we have also outlined in one of our leading papers, as you can see in the sources, a large majority of retail clients wants to invest sustainably. We identified 3 different profiles, 3 different motivations why people want to integrate sustainability in their financial decisions. So we recommend to first assess the understanding and the objective of your clients from a sustainability perspective, similar as you are also doing it for the financial understanding and objectives. And these 3 profiles are, on the one hand, impact, so people who want to have an impact with their investment, people who want to exclude certain topics because they want to avoid guilt by association, as already mentioned by Constanze. And the third profile and motivation is to use sustainability actually to leverage risk and opportunities within their investment. And then the fourth profile is no sustainability preferences at all. After you have identified the objectives and understanding, this will allow you in your suitability questionnaire and in the process to then ask for the right sustainability preferences. So concrete, which impact objective would your client want to follow? Which concrete exclusion criteria would your client to apply? And if the knowledge is existing, potentially also which SRI strategy would be favorable. The next step in your journey would be then to manage your sustainability and to promise in your marketing, in your communication, really only what you can hold. As we have seen in the presentation before, this is not given, and we see indeed at the moment a growing market on the one side, a growing interest of retail investors, but on the other side, we see also a lot of greenwashing and a mismatch between actually demand and product offerings. So what is key is to first set out a strategy, a sound strategy, how you want to tackle with your organization this topic. So where is your niche? Where, with which products can you correspond to specific demands? And after you have set out a strategy, one of the first things to do is to change your product portfolio, of course. And to do so, we as 2 Degrees Investing Initiative, we have developed several tools to support you free of charge and open source. And one of them, which I can recommend, is our Transition Monitor platform, where you can, for instance, upload a portfolio to understand the climate risk which you have and whether your current portfolio is aligned with a 1.5 or 2.0 degree scenario. So this is a really interesting tool, which is already applied by several thousand investors worldwide to assess which risk from the outside world affects your portfolio. But this is only one perspective of materiality. The other perspective of materiality is to understand also how your portfolio affects the outside world, so the impact perspective. And here we also provided recently a new paper, which is called the Climate Impact Management System for Financial Institutions, where we laid out a potential system how you as an institution can manage your impact of your product portfolio. Then as a next step, after you have redesigned your product portfolio, it is really key to be fully transparent and to use only marketing claims which are based on best evidences. Why? Because as we have also heard in the previous presentation, indeed, trust, or as it was, I think, called authenticity, you could also call it honesty, are big words, but indeed, from our analysis, from our research, the most relevant currencies or assets, and at the same time, the scarcest assets and currencies within the financial system. We know, especially from retail investors, that there is a huge mistrust against financial institutions, in particular when it comes to sustainability. So being fully transparent, being fully sound in your marketing claims will bring you at the end the highest leverage in the market. So also here we provided recently a new paper which is called Sustainable Finance and Market Integrity, where we showed current misleading marketing practice with an example in France. We will replicate this kind of work to several other European countries this year, where we will also work on the topic which product categories will fall the so-called Article 8 and Article 9 product categories, which is currently probably the most hottest debated topic in Europe within the Sustainable Finance Disclosure Regulation, which went into force in March this year, and which also opens at the moment the door for potential greenwashing. And last but not least, a very crucial task and a very crucial aspect is to match your products according to your clients' real financial and sustainability preferences. And this is again a very, very complex task, because if you will go into detail, you will see that financial and sustainability preferences might have a trade-off. So how do you reflect this trade-off within the elicitation of the preferences on the one hand, but then also in the matching process? So which criteria will you hold constant, while other criteria you will match on the first, second, and maybe third layer? Here we have developed a retail platform, which was launched last year in Germany and which will be also replicated in 28 European countries end of this year, which is called My Fair Money, where we provide a fund database where you can see how this matching can be done, and where you also can find, by the way, a draft suitability questionnaire, how this can be done. But also this as an information, the suitability questionnaire is a question which is not clarified, and where we will work on in the next couple of months, and where we will provide until the end of the year a recommendation how this can be applied in the best interest of consumers. And of course, as a research organization, we don't claim to have already answers to all our research questions. So the most pressing questions where we are working at the moment is how to qualify actually high impact products, how to elicitate real preferences with minimum biases, and how to best match real financial and sustainable preferences with products, which will become more and more pressing with the increase of robo-advisors, which we observe. And here the question, which kind of minimum quality does matching algorithm need to fulfill clients' expectation? And also open questions on our side, and which we would like to address in the near future, is how and if our research is adaptive and applicable to other areas in the world, in particular to Asian countries. As you can see, our retail research stream has a pretty strong network in Europe with strong research partners, NGOs and universities. And also our funders are based in Europe. But we are very, very keen and very interested to elaborate more how our research can be replicated in the Asian market, and we are always looking for new partners and new opportunities. So if you're interested, and if some of this what we said today was corresponding to your needs or to your interest, then please don't hesitate to contact us or visit our website to get more insights from our research. So that's it from my part. I think I haven't observed the chat, so I think that there might be 1 or 2 questions. So maybe we can use the last 7 minutes to address these. Thank you.
Thank you, Nicola and Constance, for sharing your work of the research. And clearly, there are lessons for Malaysia and also rest of ASEAN to draw and leverage on this work as we move along and the consumers here become more and more aware about sustainability. We do have a question for you from the audience, and the question basically asks for your view on the sustainable investment demand among group of consumers who are not that investment savvy, especially like as seen in Southeast Asia and Malaysia.
So the question is actually like small investors, how much they are interested in sustainability. Is this correct?
Yeah,
Okay.
the awareness of sustainability in small retail investors.
Yeah. So according to our research, we don't see, in fact, a huge difference between the size of investment and the interest in sustainable finance in Europe. That needs to be said. So this is an indication that the market has already such a coverage that even people with less financial means are interested, and not only financial means, but also in general with lower education are already interested in sustainability, because it just has become such a overarching issue in Europe. I can't speak for Asian countries. That's what I said. We would need to replicate our research to give you a clear answer. I know that there are some consumer research already done in Asia, and I know from them that indeed there were also pretty high numbers in general of interest about sustainable finance, but I can't say how it was for small investors in Asia.
I think maybe to elaborate a little on this, as Nicola said, Southeast Asia and especially Malaysia hasn't been our research focus in the past few years. But I think there are some lessons in order to really estimate this demand also in other countries that can be drawn from what we have said so far. So number one, really, you have to really bring this topic up in order for people to have the opportunity to at least mention those things, because they might not come as naturally for them as they could be. And good questionnaires regarding this could be a good focus. And in general, I think there's no reason why this should not be also a topic for Southeast Asian retail investors, because I think at least personal values, religious values, moral values are something that is, in my understanding, quite universal. And also seek investment opportunities from ESG integration is something that is at least very universal, if maybe the impact focus that we see in Europe is not as universal, maybe as other motivations. But this is really something that needs to be researched more in the future, I think.
Yeah, it's very interesting, Constance, that you said religious views, because with Malaysia being an Islamic finance hub and the convergence of principles of sustainable finance and Islamic finance, it probably would make most sense to Malaysia in ASEAN context than most other countries.
Definitely, yeah.
Thank you, Nicola and Constance. That was really insightful. Thanks for sharing your research and work. Before I invite the next speaker to wrap up today's session by giving us a summary of key takeaways for Malaysia, could I request the audience for their support in answering a couple of feedback questions as to how did they find this session? This will help us improve the content we are bringing to you through this conference and the future events. While the questions are displayed in the poll, I would simultaneously invite and have the pleasure to invite our next speaker, Angelia Chin-Sharpe, the CEO and country head for Malaysia at BNP Paribas Asset Management, for concluding key takeaways from today's sessions with a few words. Angelia has over 20 years of experience in banking, capital markets, and asset management. She was ranked 14th most influential women in Islamic banking and finance in the Women I 2019 report and received the Community Achievement Award 2017 by the Malaysian Australian Alumni Council. Over to you, Angelia. My pleasure to have you here.
Okay. All right, I managed to unmute myself. Thank you very much, Sonia, for the very kind introduction of myself. At last, we have come to the end of our very intense first day of the JC3 Flagship Conference Finance for Change. As a representative member of the Joint Committee for Climate Change and on behalf of JC3, I would like to say a big thank you to all our speakers and their generous sharing this afternoon. To all the participants, thank you for staying till the end with us and sustainability and ESG is no longer an option. The we only have to say we 3 trillion
Angelia,
US
sorry
dollar.
to interrupt, but we are losing your audio.
Oh,
sorry to interrupt.
Can you hear me?
Yeah, we can hear
you hear
you
me?
okay now.
Yeah, sorry.
Yep.
Okay, so I was just saying wrapping up the whole session about starting first with Russell Marsh. He started his presentation that sustainability and ESG is no longer an option. The message is clear that climate action failure is the greatest risk for all of us. First, we only have one planet, and unlike COVID, we have no injection to cure the effects of global warming. And we know that at least 3 trillion US dollar of capital is needed for solutions to transition us from our current economy to a more sustainable economy. This presents opportunities for investors too in creating new products as government and policy makers put in place regulations to accelerate our pathway to carbon neutral by 2050. Clearly, business as usual cannot continue and in fact pose risks to investments. While there is different iterations on what carbon neutral, carbon negative, net zero means, Arina Koch also discussed on the 6 focus areas Malaysia needs to look at as Malaysia commit itself to its 2030 target as agreed in the Paris Agreement. Arina also shared that the integration of ESG affects every facet of the organization, operational structure, legal, including shareholders and stakeholders engagement. Management and board will need to address this as they embrace ESG within their organization. While the whole day we have focused many on our discussion on the role finance sectors and other business can play in addressing climate-related risks and its impact, Suzanne reminded us not to forget to put on our gender lens. Women remain the largest majority living below poverty. Clearly, we can all bring together gender and climate together and create opportunities for a more inclusive economy. As she said, climate smart investing is smart investing. It is good to see from the poll that most managers are looking at integrating ESG into their investments. Maria Gauthier welcomes managers to look at the WWF Respond to help them set their benchmark to look at as they set out their respective ESG framework. Engagement are key, and she highlighted the importance to set time-bound objectives. She encouraged managers to integrate science-based targets into their ESG strategies and apply more robust expectations toward investee companies. And let us not forget to also look at addressing biodiversity crisis in our considerations. Thanks to Daniel Ng and Louise Kooy-Henckel, we had the front row seat to see how global asset managers like Aberdeen Standard and Wellington Management, in their respective ESG journey, both sharing the need for active engagement. Being authentic matters, as what Louise say, clearly no greenwashing. While clients and regulators are setting the pace, embedding ESG is not only about delivering a more sustainable performance for their clients, but it is also about risk mitigation. In a poll conducted by Nicola and Constanze of 2DI, our participants responded that only 26% retail investors were not asked at all on their ESG expectations or preferences, while 21% only fleetingly discussed on this topic. Clearly, there's more to be done. While European investors European retail investors continues to lead on demand for sustainable investments, consumers are becoming more aware of impact of climate change. We therefore should not be ignorant on the changing consumer behaviors and preference, which can even hit our shores here in Malaysia. So I think 2DII has a tool which they offer free of charge for managers if they want, so that we can all surf the wave without crashing. While we do not see Malaysian managers ranked yet by WWF, I'm hopeful we will see Malaysian asset managers rated soon. As asset managers collectively with the assets we manage, clearly we can all be a force for a better future to build a prosperous, sustainable, and a more inclusive economy for tomorrow. We must rise to the occasions as future makers and build back better. A reminder that we do not have an injection or a pill to reverse the damage caused by climate change, but I am hopeful we will overcome COVID soon. So with this, I wish you all a very good evening. Get vaccinated and stay safe. See you all for day 2 track.
Thank you, Angelia. Thank you for summarizing it so well. I would like to now thank you all for staying with us and for your active participation throughout the day. Please join us tomorrow for discussions on sustainable finance and management of climate change. We will be discussing Bank Negara's green taxonomy, giving tips to operationalize the TCFD, providing insights on climate risk disclosure, and more. We will also be hearing from the Ministry of Environment and Water on the national agenda on sustainability and from the Minister of Finance on sustainability in public finance. I hope to see you all tomorrow. I would just like to once again thank all the partners. The JC3 Finance for Change flagship conference is co-hosted by Bank Negara Malaysia and Securities Commission. This event is supported by the UK government's Low Carbon Energy Prosperity Fund program in partnership with EY. This conference would not be possible without support and hard work from CIMB, SME Bank, and Zurich, and without help from our knowledge partners, Climate Governance Malaysia, WWF, FIDE Forum, Swiss Re, Fair Finance Asia, AFI, and IFIM. Wishing you all a very good evening ahead. Thank you for joining us. I am now officially closing this event. Thank you.